is chugging along with a greater degree of certainty than on April 2nd. I'm just wondering if this is a broader economic kind of read-through, as John's been asking all morning, or if this is something that really indicates the banks have been much more cautious with who they lend to, the creditworthiness of all of their clients.
Yeah, I mean, I think what we're seeing and what we're hearing is that there's obviously always tail risks here, and I think people are cautious to make sure that there's a lot of macro events that are occurring. Tariffs are still uncertainty there. There's geopolitical risks, and so I think there's obviously a sense of cautiousness, just to be careful that you're not getting yourself in trouble. But overall, the trends that I think banks are seeing right now, and that we're talking to both investors and CEOs about, is that things are good out there. The consumer is in still a very good spot. The low end of the consumer is being more affected by inflation, and there's maybe a little more challenges there. But more broadly, the consumer is in a great spot. And then companies, as you see in investment banking activity, are leaning back in. So they're going back on offense. M&A volumes are picking up. Companies are feeling good about raising capital. Their stock prices are at all-time highs. So I think there's a really good sense of kind of optimism in the market right now from both corporates and consumers, and that's what I think we're going to hear from virtually all banks through earnings season here. There's
really a question about whether this is a pivot point, or some of these banks that have been treated as though they're utilities for the past 10 years can become more growthy, especially if they start to get deregulated to the point where they can compete more aggressively with private asset managers. Do you see that as a likelihood this year?
Well, if you listen to JP Morgan's call yesterday, a lot of questions on fintech, a lot of questions on stablecoins and tokenization. So I think the conversation is evolving a little bit. Banks are still, I think, obviously, steadier types of business models, and they're not going to take a lot of risk. But this world of kind of less regulation, I think, is starting to creep in, and I think is going to be a tailwind for banks over the next couple of years. And then on top of that, I think another catalyst here is consolidation. You're starting to see a little bit of bank mergers. It's going to be in the kind of the small, mid-sized banks, but I think that's going to be very valuation enhancing. And I'd look to the back half of this year to start to see some of that. And I think that will be a catalyst for the broader group, something that we really haven't seen over the past 4 years.
So, Devin, just drill down on some of that. As you mentioned earlier, some of these ideas became very consensus, Goldman being one of them, and it's certainly performed. If you were looking for something non-consensus, something a little bit different in this sector, maybe the broader industry group, what would you look for?
Yeah, so we're kind of, some of the large cap names I think are pretty well owned right now, as kind of the index plays. So we're looking at some of our mid cap coverage. So a company like Stifel, which kind of looks like Morgan Stanley in terms of wealth management and institutional exposure, but much more reasonable valuation at kind of 11 times our exit 2026 earnings level, but still get some of those really good exposures. Then they also have pretty good leverage to bank M&A with their KBW business. So kind of that theme that we just talked about. So that would be one. A small cap advisory boutique called Perella Weinberg is a name we really like. So we want to be selective here just after these really big runs. And then I'd also, regional banks, as I just mentioned, with bank consolidation and deregulation. I think that can have a bigger impact on their business models as well. So broadly, that is a kind of an index play.
Hey, Devin, appreciate it. Thanks for giving us some time. Busy morning for you, I know. Devin Ryan there of Citizens. The final point there, similar to what we heard from Chris Marinac in a previous hour. As for Goldman, the move we've seen, 52% off the lows of April, up more than 20% for the year so far, and up again so far this morning.
And frankly, the numbers are justifying it. They just had a record trading haul when it came to their equities trading business, and you see across the board positivity. Question is, how high has that bar gone? And do you start to see some of those regionals really start to outperform in a more meaningful way?
1 hour and 50 minutes away from the opening bell. Let's get you some morning moves, including the financials. With more is Danny Berger. Hey, Danny.
Hey, John. Just want to put them all together so you can get a kind of clean read of where we're trading. It's both Bank of America and Goldman that are gaining in the pre-market. Both of them strong loans, strong trading, especially for Goldman Sachs, as you've been talking about. The one laggard this morning is Morgan Stanley, despite some beats there. Not good enough, though. The other set of earnings we had this morning, about an hour, a little bit more than that ago, was Johnson & Johnson, a beat and a raise for the pharma company. 2.3% is where it's headed higher in the pre-market trade. That's despite what's likely to come in terms of sectoral tariffs for pharma. That's despite some of the cost breakdown, some of the cost pressures from the federal government for drug pricing, but the CFO telling Bloomberg that the tariffs are actually a good thing because they will come in 18 months, giving them enough time which they have been doing, ramping up some of the production in the U.S. Finally, the crypto stocks, a good day for them. Legislation is making its way through the House after a stablecoin passed in the Senate. There were some conservative holdouts, but the president said yesterday that he talked to members of the House and was able to get them on board. So you can see a lot of those stocks gaining at least 1.5% this morning, John.
Hey, Danny, thank you. Appreciate the update. That stablecoin push is becoming a bigger and bigger feature of the debt market. Fixed income, T-bills, and demand for treasuries.
Yeah, could they issue stable coins as one way of diversifying the deficit? And that's actually something that they're talking about increasingly. And that's the reason why you're hearing people like Jamie Dimon yesterday asked about stable coins in a meaningful way. Yeah, I don't know. I mean, do you think this is going to be actually something that we're going to see?
I think we're seeing it, aren't we?
Well, not stablecoin issuance instead
No, but
of
we're
treasuries.
seeing the demand for T-bills because of the demand for stable coins, and ultimately, if you loosen up the regulation and encourage some of that movement, that's the direction of travel.
Yeah, I keep thinking about, and yes, okay, and the reason why I seem distracted is I'm still thinking about what Shonali said, the fact that headcount in Goldman Sachs went down, but that overall compensation went up. I'm sorry, I'm distracted by this because I keep thinking about
We're changing topics, just to
I'm
keep
just
up.
changing
Okay,
topics.
all right.
I'm sorry. I mean, stable coins are
I was
fascinating.
waiting for you to link the
etc.
two.
No, I'm not going to link the two.
Okay,
Maybe
all
it's
right.
just that there are people who are investigating stable coins and technological prowess. I'm not even going
Not
to
gonna
try
try?
to put that
All
in.
right, shall I move on?
No, I mean, I just think that's really interesting. People will get paid more, but there'll be fewer of them. And what this does to the ecosystem of jobs. I just think that's really interesting.
Thanks for sharing your thoughts. No, I'm with you. I'm with you.
Anytime. Do you want me to keep going with
No,
coins?
I'm going to go now.
Okay.
Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. Shares of NVIDIA closed at an all-time high yesterday after CEO Jensen Huang said he expects to soon start getting those U.S. licenses allowing NVIDIA to export its H20 chips to China. Speaking in Beijing, Wang said he met with Chinese Vice Premier He Lifeng, and they discussed China's openness to foreign investment. Meanwhile, ASML shares are falling after the chip equipment maker struck a cautious tone on its outlook for next year. That's because despite a positive performance, the company says tariffs are muddying the picture for forward guidance. Its CFO did say that lifting chip controls on China would boost demand. And the maker of the ultra-popular Labubu dolls, Pop Mart, says it expects first-half profit to jump at least 350%, fueled by global demand for its hit collectibles. Celebrities like Rihanna and superfans have pushed the plush monster dolls into international stardom, helping the toy maker's valuation exceed $40 billion. I think they're ugly. That's your Bloomberg Brief. John?
Yahara, thank you. I must be getting old. I've got no idea what they are.
Really?
Zero.
Boo-boo-boo-boo-boos?
No idea.
Honestly, I can't even say it. La Boo Boos by the Boo Boo.
Anne-Marie's lighting up the group chat right now.
Oh my God.
Don't admit that. Apparently,
What?
I shouldn't admit that I don't know what they are. I don't know what they are.
They're popular dolls,
Okay.
and a lot of celebrities have them, and I don't really get it. I don't really get it.
Yeah,
I don't really sleep with dolls. I'm just saying.
I mean, I
Let's move on.
don't know if we needed that clarification. Up next. Okay. Up next, the search for the new Fed chair.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed.
Here in New York City, we'll catch up with the former World Bank President, David Malpass.
in case you missed it on Bloomberg Insight.
I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting that. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary. And this is not all an American thing. You know, with all those things taking place, yeah, you may be surprised.
I spoke to Jamie Dimon. He says that we should actually prepare for stagflation. How do you square that?
I think there's no question that the shock of tariffs are stagflationary. The question is going to be ultimately how high do they settle at? Right now they're at a very high level, highest in 100 years, and how long a period both is this uncertain environment and how long are the tariffs going to last? And the question now is the magnitude of the stagflationary impulse, and we just don't know yet.
Don't miss Bloomberg Insight live weekdays.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question. Get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda on it. Only on Bloomberg.
Bringing you the tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Equity futures on the S&P just about negative by not even a tenth of 1%. On the Nasdaq 100, we're down by 0.2%. One of our main stories over the last 24 hours under surveillance this morning, the search for the new share.
There's a formal process that's already starting. There are a lot of great candidates, and we'll see how rapidly it progresses. It's President Trump's decision, and it will move at his speed. I have the best job in town. I will do what President Trump wants. We got a lot of great Fed candidates, and I'm confident it's going to be a robust process.
So here's the latest. The NEC director, Kevin Hassett, taking an early lead to become the next Fed chair. Sources telling us here at Bloomberg that both Hassett and former Fed Governor Kevin Warsh are the top two contenders. Joining us now to discuss AMH. Anne-Marie, we're not going to talk about dolls. We're talking about the future of the Federal Reserve. Why is Kevin Hassett front of the line?
Well, right now, this is an individual that's very close to the president, and clearly he's had a lot of face time with the president, and you've seen a clear change of tone from this individual who used to go around and say his job as running the NSC was to make sure that he would talk about the independence and really encourage the independence of the Federal Reserve. The Treasury Secretary would call it the jewel box of monetary policy. And now, at the same time that he's having these meetings, according to the Wall Street Journal, he is also going out on television and talking to people and bashing Jay Powell and saying that he was political last year, cutting rates into the election. So this is something that likely the president likes to hear. This is someone that he would be willing to cut rates, and he's telling people inside and outside the administration that he would like the job. The president also said yesterday, which I thought was really interesting, that Scott Bessent is still an option, but he's not his top option because he liked the job he's doing at Treasury. And we've been talking about that really for weeks. If the president was going to pull the Treasury Secretary to move him over to the Fed, this would create almost another problem and a huge hole for the president. I also think it's noticeable. We should remember there could be a dark horse candidate. The Treasury Secretary yesterday said his or her nomination. Would someone like Mickey Bowman potentially get the nod? This is the start of the formal process.
Anne-Marie, thank you. That process has begun. Joining us around the table, a potential candidate, the former World Bank President David Malpass. David, good morning.
Good morning, John.
Would you like to be considered?
Of course. So it's a huge job and really important to the Trump changeover that's going on in the world, saving the country. But it means a lot of change at the Fed. I think they've been making many mistakes, and we can enumerate them. And that will mean more growth, and especially more growth in median income. If the Fed were allowing more small business growth, there'd be more jobs that are new jobs for people across the country, not just in urban areas.
Well, let's get into some of the details. Walk us through a couple of the examples where you think they've made mistakes and the remedies for them, how you'd correct course.
You know, I didn't like QE. Think about QE, that the Fed in its wisdom is going to go buy bonds. So how did that work out? They've lost $1 trillion. They'll lose much more than that before they're done with the losses on the bonds. In addition to that, remember, they've paid out in interest constantly since 2009. They've paid $1.3 trillion of taxpayer money to banks and to money market funds. That's the source of funding that they have to buy the bonds. So this has been the worst hedge trade in history. So that's a big mistake. It's also led to inflation because the Fed really allowed a merger of fiscal policy and central banking or monetary policy by buying bonds as the government was really jacking up the deficit.
Well, you're out of the running already, because I have to say, isn't that exactly what the president would like to see?
What would he like?
President Donald Trump would very much like to see monetary policy and fiscal policy very well aligned.
No, I think he wants to see them both improved and is already doing that. The reconciliation bill improves fiscal policy, and the separation, what we need is lower interest rates, and you can't do that if you've got the Fed carrying the load of all this fiscal deficit that Congress is generating.
So in the near term, as a candidate yourself, what do you do as a potential new Fed chair to the composition of the Fed and the approach that you think right-sizes it?
I think really important is people to see the flaws of the inflation targeting model. I've been writing about this literally since the 80s, that if you target inflation as your goal, it's backward looking and it doesn't comprehend all of the prices within the economy. It's just a flawed indicator, but that is the basis of how the Fed sets interest rates. So one of the things is you switch and you say the dual mandate is to have price stability. That's very very different from CPI inflation, which wavers around and gives you false signals. That's what's happening right now. So you need lower interest rates because of the strength of the U.S. economy. I think that's something that I understand a lot from working all over the world and in Wall Street, in financial markets, that the U.S. is this giant power, and people want to invest in the U.S. even at lower interest rates.
Okay, this is a fascinating argument. It's one that President Trump has talked about, the idea that it should be almost a credit rating of the United States that backs what our interest rates should be. So like a Microsoft or an Apple, the borrowing costs should be very low. People are pegging it to inflation and they're pegging it to growth. I'm just wondering, the market doesn't see it that way, right? We're not there yet. So at this point, how potentially perilous is this discussion at a time where the market associates lower interest rates with faster inflation and frankly higher borrowing costs for the United States?
The market's inbred with the Fed, and so as long as the Fed is the sheriff of the land, the market is going to say, oh, we operate on that model. But as you change to a model that makes more sense, one that's based on the growth in credit of the U.S. has something to say about what the interest rates are that we should pay, that can be a smooth, safe transition. But it has to be explained. Markets adjust. Think of what's going on tariffs now. There was a giant panic that didn't materialize. The change in the Fed system is as big as the change that we need in the trading system, and it will work better for growth and especially better for the forgotten man. The median income has been doing very poorly over these maybe 20 years, and so if you have a system that's very focused on defending the dollar as the global reserve currency, and then people flooding into dollars, that's actually supportive of markets.
Seconds left. Have you spoken to the president about the role?
I don't want to talk about the process. What I really want people to focus on is the models that need to be changed.
Okay.
We can have a much faster growth economy with different Fed models, and it can be done with the confidence that is absolutely necessary.
We can have a longer conversation about that next time, sir. Appreciate your time.
Thanks.
And best of luck. The former World Bank president, David Malpass. Up next, Phil Camporelli of JP Morgan Asset Management, Stephen Trent of Citi, Yelena Shuletseva of the Conference Board, and Ian Lincoln of BMO.
Let's talk about this villa. Very traditional. A lot of things of the past.
I live my very first independent life in the farmhouse. And I built it by the memory of the farmhouse, the philosophy they believe, yin, yang, 5 elements, the concept of the life, of the happiness. They build this kind of roof, like boat, and man and woman, and bowl of rice. Everyone should be happy if have somewhere to live, something to eat, and someone to love.
So you're defined a lot by your past experiences.
Yeah, actually, I'm a lucky man because not everyone should have the experience of the war and peace, poor and rich, technology progress, a change during my life, rich by experience.
There's an appreciation for what you have now.
And therefore, peace is the most important thing for today, for Vietnamese, and I think for human beings, for the world.
Flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me.
Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day. 5. Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Sentiment is no longer bearish. We're now in a bullish position.
There's so much in this market that is really attractive.
Equities are a great asset to capture.
Investors are very reluctant to sell today.
What people are trying to do is to trade the data points as they see them.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
A trading boom supporting earnings on Wall Street. The big banks delivering big time. Equity futures so far this morning just about unchanged. Your scores look like this on the S&P 500. On the NASDAQ 100, down by about 0.1%. Bank earnings on Wall Street behind us now. In front of us, 8:30 Eastern Time. Another read on U.S. inflation. This time, it's U.S. PPI.
Yeah, let's see if the narrative shifts at all. Yesterday, the narrative was something like this. Oh, it's disinflation. 5 straight quarters of declining CPI month over month. And then, oh, actually, it's inflationary because the tariffs showed up when it came to certain goods pricing, in particular household goods. Do you see a similar read-through in PPI? And then do we focus on the beige book this afternoon? You know, happy beige book, John.
I'm going to move on from the beige book. No, it's important. I'm going to focus on retail sales next. And this is why, really, we've been talking about it all morning. If the composition of spending is starting to shift, people are paying up for goods and then leaning away from services to afford that, does the rate of spending change? So we know about the price of goods. Now we need to understand about the spending, how consumers are really pushing out those earnings and what they're going to do in the next few months.
Yeah, are consumers just being smart? They're going sort of whack-a-mole, where prices are best, and they go there, and then, frankly, they kind of take a step back in terms of spending in other areas, but overall, the pool of money stays the same? Or is it going to cause people to retrench more fully? This is a complicated story. And that's the reason why everybody has a different interpretation of it. Right now, we hear from the banks consumers are strong, creditworthiness is good. And then we hear that on the lower end, consumers are pushing back. Retail sales will show that in a more holistic way, as well as an ongoing slew of earnings that go beyond the banks to what exactly retailers, what exactly airlines are going to show.
So, of course, I will look at the beige book. Of course.
Of course. Happy Beige Book Wednesday. Come on, let's make this a thing.
This meeting at the end of this month could be quite controversial. I think it's going to be very interesting. It's going to be quite spicy. Might actually get some dissent at the FOMC.
And there are going to be questions about how politically motivated these dissents will be. And I think that that is somewhat unfortunate because there is a very real economic discussion around whether there should be a more active discussion about cutting rates at a time where you do see signs of disinflation and you do see signs of weakness on the margins. That said, I just wonder how much having Fed Chair Jay Powell on the chopping block, the chopped, is going to be really an increasing discussion, and you've got the potential candidates raising their hands.
Was that your impersonation of the president?
I don't know what that was. I don't know what that was.
That's what it sounded
Let's just
like.
move on.
Okay, I'm having to move on. Chris Waller. I think it's unfair for Governor Chris Waller. Of course he wants to be the Fed chair. Why wouldn't he want to be the Fed chair? He's a Fed governor.
Of course.
Makes perfect sense. He's also delivering quite a credible argument to reduce interest rates, which many economists on Wall Street agree with.
That's, I think, the problem here, is that there is a credible argument, and how much does it get undermined by the ongoing politicization of what's going on with the Fed? The bigger question that I think is increasing, and I see all of the webinars coming through, you know, what happens to markets if President Trump fires Jay Powell? Who is the credible candidate, and what does the market response look like if there is someone selected who they believe will be an actor of President Trump and will cut rates unilaterally regardless of the economic backdrop?
What matters is who replaces him. Many people on this program have said that. And to get to a confirmation hearing, you need to make sure you don't upset this market too much. Because if this market pushes back, as we've said on this program, this market will vote and vote and vote and vote long before the Senate even has a hearing.
And the vote that would be negative, just to sort of give you an anatomy of a lack of credibility of potential Fed nominees, would be a significant dollar weakening and a significant yield curve steepening. And that's what a lot of people are concerned about, the idea that cutting rates now leads to faster inflation later.
Which might make it harder to cut interest rates down the road.
Yeah,
so
there you go.
Here we are. Equity futures right now in the S&P 500 just about unchanged. Coming up this hour, Phil Camporelli of JP Morgan Asset Management on his overweight allocation to equities. Stephen Strent of Citi Research looking ahead to earnings from United Airlines, and Yelena Shuletseva of the Conference Board on signs of a clear tariff pass-through. We begin this hour with stock steady as investors await more inflation data. Phil Camporelli of JP Morgan Asset Management writing, uncertainty is moving to certainty, which will allow the market to continue to grind higher. We believe the S&P 500 has a reasonable shot to hit 6,500 by the end of the year. Phil joins us now for more. Phil, good morning.
Good morning.
Where are you seeing certainty, sir, and what issues?
Yeah, I think the three big kind of areas and clouds of uncertainty this year. The first was, of course, tariffs on April 2nd. The second was Federal Reserve kind of independence, which you guys have been talking about in the past couple of minutes. And then the third piece is, okay, what do we do about economic data and inflation based on tariffs in conjunction with fiscal policy? And you put all those three things together, and I think that's where our kind of fundamental story is growing. So when you say an overweight to equities, we try to line it up three ways: the fundamental story, the technical story, and the valuation story. And from the fundamental side, listen, we've dropped our recession probability from a coin flip in April, 50%, all the way down to about 20%. And I think a large part of that has to do with an effective tariff rate that we think is going to be between 10 and 15%, somewhere there. But at the same time, this big, beautiful bill, right, is introducing some really important dynamics around, which you've probably talked about, the permanent R&D expense story for AI companies. And then the other piece is deregulation. So the deregulation story around financials. And I think when you're looking at these financial reports over the past couple of days and the commentary, these M&A deals are happening. It's almost like chaos and uncertainty is just a given, and it's not holding people back. And the cyclical story can continue to remain. That's what we've heard from a couple of banks.
Part of the reason why there's a lot to unpack there. I want to start with the one big beautiful bill. People talk about how this gives people certainty. There will be a greater degree of investment in 2026. Can you just look past this year entirely and head to 2026 and just go la 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 uncertainty? I'm just going to move past it.
Yeah, and Lisa, I think that there's a little bit. We're going to put that to the test this quarter, because I think this quarter is when you might see, and we started to see a little bit in goods inflation yesterday. Maybe we'll see it in PPI, later this hour. We're going to start to put that to the test of whether this inflation story that can percolate and maybe a slowdown in growth can be looked past into next year. And I think that's what the market is telling us. And the Federal Reserve is also telling us that if the labor market even budges a little bit, that they'd be ready to ease. But Lisa, I don't think there's any reason for them to ease right now, right? And I think that's what is playing out in the market. The 10-year note should be at 4.5% if the Federal Reserve maybe goes once this year. And that's where we're heading.
Let's get into it. You said that the other potential risk was a loss of Fed independence.
Yes.
That hasn't exactly gone away. I mean, it seems like if anything, it's kind of got heated up.
Yeah.
So why can you dismiss that as something that isn't a huge risk?
Yeah, there's two people that hate when stocks go down and bonds go down: me and Treasury Secretary Bessent. Right. So I think that Lisa, is a trip to 5% on the 10-year note in a heartbeat. And you mentioned it, right? Dollar weakness along with a rise in rates. If there's any sniff that the market is saying that the Federal Reserve is the puppet of the administration. And, back in April, when President Trump called Jay Powell a major loser would have been okay. Major loser was a step over the line. And rates shot up. you know, that's I think when the administration pivoted to more of what Treasury Secretary Bessent was saying in February, that the administration wants lower rates. So we believe, you know, never assign a 0 probability to any event, but a very low probability that Jay Powell does not make it to May of 2026, and then we'll see who the new chair of the Fed is at that point.
You mentioned the weaker dollar, something Lisa's been talking about all morning for good reason. Typically, we wouldn't talk about how to balance your dollar exposure because it's what you wanted.
Yeah.
It's what you demanded. You wanted exposure to dollar assets, including the exposure to the underlying currency.
Yeah.
How are you approaching that situation now?
Yeah, so we as you know, we're global allocators, right? And that was like the worst thing you could possibly be, other than 2017 in the past few years, because not only was the U.S. market doing exceptionally well, but you also had dollar dominance. And what we've really appreciated this year is that this has been the worst 6-month run for the U.S. dollar to start a year than at any point since 1973. Let's just start there. It's been 50 years since we've seen the dollar weaken this much. So for us, you know, that's a major story in how we're allocating assets, that we can make a bet on non-U.S. stocks, right? And that's part of our overweight to equities, with the belief that the U.S. dollar will continue to normalize. I don't think U.S. exceptionalism is going away. I think that's like internet fodder. I think U.S. exceptionalism is normalizing to the point where the U.S. dollar at this point can be a tailwind for investors in the U.S. investing abroad. Why? Because you have growth converging with the rest of the world. You have interest rate policy in the U.S. converging with the rest of the world, and you have fiscal policy. You know, I've been talking about this story for a while. The fact that we have not only the U.S. but other countries doing fiscal stimulus, John, is particularly Germany, is a big story.
Let's stay on the dollar weakness.
Yeah.
Shouldn't that also be a tailwind for international earnings?
Yeah.
For U.S.-based companies?
Yeah.
Isn't that an argument to get long the earnings story of the multinationals based here in America?
Yeah, and that's part of our thesis as well, John, is that PE sitting at 22 times sounds expensive, but if you get the tailwind from dollar weakness and bringing those earnings back to the U.S., that's an important thing. And then the AI story. I think the last two trades that we did in equities were to communication services and to technology. So we're still 2 handles lower on PEs on the Mag 6. So we're just excluding Tesla for a second on Mag 6 than we were before DeepSeek. It's hard to imagine DeepSeek was 2025. That seems like 2023 at this point. But we're still 2 handles below. So we still have a valuation upside potential for those Mag 6 companies. And those Mag 6 companies do not need a rate cut from the Federal Reserve, which is also an important theme.
So the 3 prongs, valuations, technicals, and fundamentals.
Yeah.
Valuations, definitely not good enough in terms of any kind of earnings beat that we can see. I mean, Goldman Sachs just had a record quarter when it came to equities trading revenue, and the shares are up %. Okay, they're throwing them a bone. How much does that threaten and raise the bar so significantly high for all of the high flyers pretty much across the U.S. equity market?
Yeah, I'm with you, Lisa. That's what 22 times is you better show us something really special, and the onus now is on the earnings and growth story in the next couple of quarters to kind of substantiate those 22 times earnings. But again, if I could just differentiate a little bit, the 494, their PEs are at year-to-date highs. But the discount of the premium that the Mag 6 have over those 494 is the cheapest since 2017. And we're still 2 handles below where we were pre-DeepSeek. And again, if you go back to that big, beautiful bill, R&D, expense, and deregulation, I think those 2 things can really help the AI story, which is where we're finding kind of value in the U.S. market. And then outside of the U.S., the global diversification is really working for us.
Are you finding yourself focused more on 26 and much less on 25?
The only thing about 25 that's left is the Federal Reserve kind of direction of travel. I think that is going to be a really important theme for investors. But at the end of the day, if the Federal Reserve is not moving policy because growth is moving back towards trend and maybe inflation is staying a little sticky, we can buy into the nominal growth story. Those cuts are just being priced out. So there's 4 cuts priced in. If those 4 cuts continue to happen at some point, that's okay. However, if inflation were to really unravel and those 4 cuts become 3 or 2 cuts, that's when the market pulls back by 5 to 10%.
If someone was listening to this and thinking to themselves, I thought that there were still tariff negotiations going on. I thought that maybe Europe was going to get something like a 30% tariff rate. It could even go up if they put retaliation on it, and that potentially could hit things. Are you just saying ignore that? It's going to be noise? Are you saying that it's likely that there'll be some sort of agreement that won't be overly punitive where it's mutually assured destruction?
Yeah, so it's a combination of we're not going back to April 2nd, which was the 30% effective tariff rate. So we're believing somewhere between 12 and 15% effective tariff rate. But Lisa, the big piece of new news was the big beautiful bill, right? So if you get that kind of story that I was talking about deregulation and R&D, that is offsetting the tariff costs almost perfectly. So that, I think, is the big new piece of information that investors are dealing with that allows them to look past just the tariff story.
Phil, it's good to see you.
Great. Good to
Thanks for dropping by.
Right.
Thank you, sir. Phil Camporelli there of JP Morgan Asset Management. Equities just turning positive, just by an inch, by 0.02% on the S&P 500. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Arnott. Hey, Yahara.
Hi, John. Big bank earnings wrapping up with Bank of America, Goldman Sachs, and Morgan Stanley all reporting. Goldman shares are higher by 1% after the bank posted a Wall Street record on its equity trading numbers. Meanwhile, Morgan Stanley also beat estimates on trading but fell short on advisory fees. And Bank of America shares are rising 0.8%, with traders there posting a record second quarter. Meanwhile, Congress is a step closer to clawing back billions of dollars in funds for public broadcasting and foreign aid. The Senate voted to advance $9.4 billion in cuts, which would cancel funds for PBS and NPR. If the Senate approves the package of cuts today, it will go to the House, which plans to vote before a Friday deadline. And New York City mayoral frontrunner Zohran Mamdani met with about 100 business leaders from the Partnership for New York City. At the meeting, he said he would discourage the use of the anti-Israel phrase, globalize the Intifada, but stuck firm on his other policy goals, including freezing rent and hiking taxes on wealthy New Yorkers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Up next, the Morning Calls Plus, Stephen Trent of Citi Research, looking ahead to earnings from United. That's next. This is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
There were not great beats here in terms of what you saw in the quarter. I think that smooth is the operative word. I think the challenge right now is, can these companies add to their growth rate to where they're taking away share from other parts of the financial ecosystem. Right now, we're not seeing that. I just think it's a question of adding, going from 55 miles an hour to 60, not necessarily 55 to 75. That, I think, is the nuance that we have to see in these companies at this point.
There's another problem for some of these companies that good right now just doesn't seem to be good enough. We've had a major rally, some decent numbers, and this is the price action, positive by just 0.5% on Bank of America. A record trading call for Goldman on Wall Street for the equity trading business, and we're higher. You said it, Lisa, higher by only 1%.
And it just shows how high the bar already was coming into this. Is this just a banking story? Is this a story for all the high flyers, including big tech, when they report earnings? NVIDIA, of course, reports earnings like next year for the second quarter, but
gotta fix that.
It's true. I mean, come on, it's a quarter.
Bring it forward. I know.
Get with the program, guys.
Jensen, fix it. Do whatever you want. Do whatever you want.
He does.
Equity futures on the S&P 500, positive by not even 0.1%. That's some of the price action out there this morning. Take the morning calls. First up, Wells Fargo raising its price target on JP Morgan to 325, believing its second quarter results support higher estimates. That stock is up by 0.1%. Your second call from Needham raising its price target on Alphabet to 210, citing its strategic position and YouTube's strength in the TV space. And finally, JP Morgan raising its price target on Boeing to 230, saying strong deliveries support the company's second quarter. Sticking with aviation, United Airlines reporting second quarter results after the closing bell. Investors looking for impacts of air traffic control issues and flight cancellations at the carrier's Newark hub. Joining us now, Stephen Trent of Citi Research. Stephen, welcome to the program, my friend. What are you looking for a little bit later?
Oh, thanks so much for having me. Appreciate that. So we do think in United Airlines' case, after the close, they'll report $3.78 a share. We remain constructive on the investment case, but I do think there could be some noise in 2Q around what happened in Newark Airport.
Just on a more macro level, there's a question about whether the consumer is still being really discerning about traveling, particularly the U.S. consumer. What are you expecting them to say about pricing power at a time when you've seen airline tickets go down, you've seen consumers domestically push back, and a lot of them have reduced capacity dramatically?
Yeah, great question. So I think that it's difficult to lump all consumers into one basket, and Delta Airlines set the tone for this. What we continue to see is upper-end consumer demand remains very good, and probably there's even a little more certainty on that demand today versus a few weeks ago, because we now at least have some color on taxation. When we think about domestic main cabin, that's been weak for everybody. And I don't expect any big rebound in that side of the fence anytime soon. But you have names like United, Delta, American that are in the right verticals, international long haul, co-branded card remuneration. These are the kind of things that are supporting earnings for the network carriers.
So, Stephen, if just taking a step back, are you saying that some of the biggest airline carriers are more credit card companies that have these sort of peripheral businesses where they shepherd people around in the skies, and that's why they can do really well, even if some of the others that are mainly just airline companies are going to struggle?
Yeah, look, the co-branded card programs are really important. And when one thinks about the level of remuneration from those programs, they are a very big deal. They are a big reason why you've seen this group de-risk its earnings stream. So if you look at today versus 2019, this is one of the reasons why the network carriers have seen such a big increase in their earnings wallet share versus discount carriers. And not to say that discount carriers don't have co-branded card programs. They do, but the economics on those programs and the amount of wealth, let's say, in Delta's frequent flyer pool versus a discount carrier's frequent flyer pool, that's a very hard comparison for the discount airline.
When you take a step back also with the macro story, there's been a big question about how the increasing tensions between the U.S. and some of its trading partners, I'm thinking of Canada, has been sort of a poster child of this, but also Europeans, whether travel, inbound travel, has really gone down and stayed lower. We've seen that at least from Canada, not as much from other places. What do you see about international travel? How much are you seeing that come back, and how much is it just outbound rather than other people maybe taking advantage of the fact that the dollar is a bit weaker?
Yeah, absolutely. So if you look at the U.S. network carriers, 80-some-odd% of international point of sale is here in the United States. So that's not to say that there's zero impact on international travel or zero risk. Certainly there are. You have some European cities, for example, that have had protests about overflow of tourism. That, at least in part, is somewhat of a risk for what we see on the international side. I think Air Canada is a somewhat different case, and what they've done, yes, you have seen less Canadian traffic flow inbound in the United States, but Air Canada seems to have mitigated a lot of that with its Sixth Freedom travel through its Canadian hubs.
Stephen Trent of City Research there. Stephen, thank you. Looking forward to your conversation tomorrow. Scott Kirby, United Airlines CEO.
You know, I think that some of these CEOs have the best view into exactly what the consumer is doing and how companies are adjusting and adapting, and they can't necessarily look past 2025 to 2026 just yet. Real questions here, yes, about the Newark hub and how much they're able to recover from that, but the bigger macro story of how much they have to continue with reduced capacity in order to keep prices sort of stable at a time of dropping demand, or do they see the same thing that Ed Bastian sees, which is a very stable backdrop with a resuming consumer demand to go around, get some sun, take a vacation, drink a beer.
I'm sold. I'm buying. Great, I'm in.
I know, 100%.
What are we doing?
I know, exactly, although I wonder where they're going.
To your point, there is a difference between what Delta has told us and what we saw in the CPI numbers yesterday. CPI numbers didn't spell out a great story for this industry.
They've showed continued declines in airline prices, and we saw them discount them significantly earlier this year. We did hear from Delta that the prices are firming up, and on the margins, that's what people expect over at United. I guess the supply-demand dynamic, how much capacity are you willing to take offline in order to get prices at a certain level? They could fill as many airplanes as they want for a price. What is that price they're targeting, and how much do they see consumers absorbing going forward? It's kind of one of the keys to that inflation puzzle that we're about to get another piece of just shortly.
The United Airlines CEO sitting down with Lisa tomorrow morning. Look out for that conversation. As Lisa pointed out, PPI just around the corner. As we start to form a better idea of what PCE will look like, we'll get those details in just a moment. We'll catch up with Elena Shuletseva of the Conference Board.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The open about 60 minutes away, seconds away from another read on US inflation. This time it's PPI. The scores into that data point look like this. Equity futures just about positive on the S&P 500, down a tenth on the NASDAQ. In the bond market, 2-year, 10-year, 30-year, check out 30s. That yield sitting right on top of 5%. 5% this morning on 10s, 446, on 2s, 394. With the data, here's Mike McKee. Good morning, Mike.
Good morning, John. It's coming in lower than anticipated at this point, with final demand headline at 0.0, ex-food and energy 0.0, and ex-food, energy, and trade 0.0. So a remarkable kind of performance there. The year over year, we're at 2.3%. That's a significant drop from 2.6%. For core, it's 2.6%, down from 3%, and for food, energy, and trade X, it's 2.5, down from 2.7. So this is a number you can bet that the White House will be touting as evidence that there are no tariff pressures. We'll have to see where the actual prices came in here. Final demand goods did rise 0.3%, while services declined by 0.1%. And this being a service economy, that probably had a lot to do with it. I'll check out the details as you check out the markets.
Thank you, Mike. Appreciate it. Yesterday, a downside surprise. Core inflation softer for a fifth consecutive month, softer than expected. PPI this morning, a downside surprise, unlocking some small gains in the equity market. The S&P 500 up by 0.1%. In the bond market, yields coming in just a little bit at the front end of the curve by almost a basis point, down about 2 on 10s, and just below that line of the sand, that 5% line. On a 30-year this morning, we're down by 2 basis points of 4.99. So, Lisa, yesterday, the headline was comforting somewhat. The details were nuanced. I wonder if it's a repeat this morning on PPI.
And maybe that's the reason why you're not getting as much of a knee-jerk reaction as you did yesterday, because if you dig into this, people are now saying core PCE. What are the components that go into that key metric that the Fed looks at? And if you take a look yesterday, especially the non-autos and trucks, you take a look at that, you could see that there still is inflationary pressure. How much housing contributes to that? Do we get a similar type of analysis from the PPI report as well?
Mike McKee, I asked this question yesterday. I'll repeat it with regards to PPI. How much comfort can we take from this morning's print?
Well, this is a little bit unusual given the drops that we saw. So it is something that needs to be looked at in depth, and we'll see, as you've been talking about, what it means for the PCE. But it does take some of the, I guess I would say, pressure off Mickey Bowman and Chris Waller, because you've got a number that could suggest that the Fed could be cutting rates sometime soon. But it really is going to depend on the detailed breakdown of where the prices did go up and where the prices did go down. If they went down, if it is because we saw a drop in services, even though goods went up, then that's not going to be as comforting because the tariffs are on goods, not services.
Mike McKee with the latest. Mike, I'll come back to you in a second. With us around the table, Yelena Shuletseva of the Conference Board. Yelena, good morning. Good to see you.
Good morning.
So we've only got so much data. We've got CPI, we've got PPI. What are we learning so far about how the cost of tariffs is being distributed across this economy?
Well, tariffs costs are definitely passing through into the consumer prices. We saw that in the CPI report. Today, I need to look at the details of PPI, but it looks like goods prices are also rising. So this is going to be a story that will stay with us for the summer months. What I will be looking at during the summer months is not only whether this is broadening into a broader kind of range of categories of goods, but whether it will also be continuously rising for the categories of goods that we saw a big increase in. And that will actually tell me if it's like inflation that is going to stay with us or if it's a one-time rise in prices.
You know, this is so difficult, Yelena. I'm looking at the revisions from the prior month, from May, and you can see all of those were revised upward. You can see that pretty much across the board, almost commensurate with how much they were reduced relative to expectations this month. How difficult is it to pinpoint at a time when the data is actively moving and there's so many moving pieces and components that are all kind of beaten to their own drum?
There are a lot of revisions. There are revisions in the payrolls data. There are revisions in the price data. I will be looking at what it means for the PCE deflator that will be released on the 31st of the month. And I guess the Fed will have a very good read of what June inflation looks like when they go into the meeting later this month.
How much is Trump 1.0 a good sort of template for how inflation will be felt from tariffs this time around? And I say this because you look at the washing machine example. Yes, washing machines became more expensive, but people bought fewer of them. We see household appliances, once again, prices increasing pretty significantly. Do you expect, and how important is it to see whether people are buying fewer of them in retail sales in some of the earnings reports?
We absolutely expect that. So, and not only with goods, but also with services. If prices of goods are going up, you will consume fewer services. And this is what I think we see in the price data. And I think that's what we're going to see in retail sales. It's actually difficult just by looking at retail sales to kind of gauge what happens to the services sector, but restaurant spending is in retail sales report. Another difficulty about looking at economics data these days is that retail sales are reported in nominal terms. So how much, if it comes in strong, does it mean it's about the prices or is it about the real spending of the consumer? I think consumers will slow down their spending just simply because they will become more cautious. They are telling us that in our consumer confidence report. And I think that higher prices will prevent them from splurging on discretionary services going into the second half of the year.
Will it prevent the Fed from cutting?
Absolutely. This upcoming meeting, I think we will see a cut in December, but the Fed will obviously need to see a clearer picture. And looking at the details of those CPI reports and PPI reports would help.
Let's get to the details. Mike McKee has more. Hey, Mike.
John, it looks like a lot of this is in the services side. There were huge drops in airline-related categories, including passenger carrying. That was down 2.7%. So that put a lot of pressure on services. When you look at the goods side, electronics actually rose significantly, and other goods such as energy also rose. So we do have some pressure on the goods side, as Yelena was talking about. On the services side, it is weak. Had we not been in a tariff economy, you would be looking at this as really good news because service prices had been driving inflation for a long time. And now it has come down, and we're kind of where the Fed wanted to be.
Mike, the Fed's in a tough spot. As you know, they're facing a lot of pressure to reduce interest rates. Yesterday, the Treasury Secretary said the president's not thinking about firing the Fed chair, and yet the speculation continues. Mike, what's your reaction to that this morning?
Well, again, and we talked about this at the Rocky Mountain Economic Summit last night at the dinner. The problem for Trump is that if he tries to fire Jay Powell has already said, and the Fed has already said, they will sue, they will go to court. And so it's not going to be an easy or quick decision, especially since the Supreme Court has already said Powell doesn't fit in the same category as the Merit Systems Protection Board and the others that the president was allowed to fire. So I'm not sure how much he gets out of this. And if anything were to happen in the near term, then that really guarantees, I tell you, that the Fed would not do anything on rates in July. And it may push September off the board because the Fed isn't going to sit back and just do what the president wants because he has a tantrum.
My question from a Bloomberg subscriber, are you in a bunker or a fancy multi-million-dollar cabin?
Somewhere in between, I would say. If there's bunkers like this, I could live here. But this is a hotel lodge out in Victor, Idaho, the big city of the western, eastern part of Idaho.
It's not bad, is it?
It still has a fireplace going. I love it.
Beautiful. Mike, thank you, sir.
Well, I know you guys like that, so I do. I put the fire. I don't
just
need
for
it,
us,
but
not
it
for
looks
you. No,
nice.
Yeah.
for us. We appreciate it. Thanks
for you.
The sacrifice that Mike McKee makes for us.
Yeah, when's he going to come back from the woods? He's out there with the
Been there
bears.
a week.
Yeah, bear bells on.
Yeah.
Fed policy.
Good for him.
Okay.
Yelena's still with us. Yelena, goods versus services. Goods versus services. What does that tell you about how weak this economy is right now? That we're
Well,
seeing that kind of dynamic take place.
That's essentially robbing Peter to pay Paul kind of thing, right? The story of two tales. I think we are going to see goods inflation rising over the summer months, and that would weaken consumer. So I think the GDP report that is coming out at the end of the month would show us weakening in final demand to domestic purchases. This is the metric that Chair Powell always cites. Even though the headline GDP number will rise probably substantially on a decline in imports. So I think the consumer is really weakening, and we will see that going into the second half. Just because, you know, these price pressures are adding to other things like the student loans not available to a broader set of consumers anymore. It's getting harder to get that loan. Delinquencies are rising. So there are other things that are affecting consumer, not just prices.
How can I pair what you just said with some of the commentary we're hearing out of the banks? We're struggling to find weakness. We think the consumer is increasingly solid. Companies have an increasing amount of conviction. From Ed Bastian of Delta, you know, we see a lot of stabilizing. We see a pretty stable backdrop. How do you square that type of commentary with what you just prescribed going forward of a weakening consumer?
I find it really difficult myself, but I think a couple of things. One is probably is not as bad as it was. So we were expecting, some people were expecting a recession even, right? And it's not on the radar anymore. So consumers are kind of in a solid pace, but it hasn't happened yet. So I think we're just at the beginning of these price increases that would weigh on consumer spending going forward. So it's simply about present versus future and what happens going forward.
Do you see a difference, because I know you track this at the conference board, a difference between the confidence levels of consumers and the confidence levels of business leaders?
Absolutely.
Is there a difference right now?
I think both are kind of pointing to this kind of a slowdown, nascent slowdown going forward. So consumers are feeling okay at present, but there's like this weakening going forward happening. So is businesses, but they're not falling off a cliff. They're not like predicting layoffs or anything like that. So that's kind of the idea that we see weakening going into the second half, but not a recession.
Yelena, it's good to see you. Thanks for dropping by. Yelena Shurateva there of the conference board on the latest economic data. PPI, at least for this month, softer than expected. Likewise on CPI yesterday. Yes, the details are nuanced and they might be concerning for many of you, but the fact of the matter is there's some better news at the headline level and certainly not what people were looking for back on April 2nd.
And so if you want to make the disinflation argument, well, here you have something that can give you fodder. If you want to say inflation still could be present, well, here's this. There was the upward revision to the May data that basically offsets any decline relative to expectations for the prior reading, the June reading. And you've got airline tickets that went down in price significantly, and that was part of the contribution to this downside surprise. Is that set to pick up? Listen to the commentary, hear what some of these executives have to say. These are the types of things people are going to be parsing through.
How do you make a broad-based inflation argument at this point when to satisfy good prices at these levels, consumers have to give up something else on services? Isn't that just pointing to the idea the economy is not strong enough, and that for inflation to pick up, for that prolonged period of spiraling inflation, just don't see it in the data in the last 24 hours?
It depends on wages. I can make an argument about anything, but with conviction, absolutely nothing right now.
Agreed.
And I think that that's where we're at in terms of inflation as well.
Is the economy strong enough to give this Federal Reserve the luxury of waiting? That's the debate they'll have at the end of this month. With an update on stories elsewhere with your Bloomberg Brief, here's Yahira. Hey, Yahira.
Hi, John. Sticking on the Fed, National Economic Council Director Kevin Hassett has emerged as the front runner to replace Fed Chair Jay Powell next year. Sources telling us here at Bloomberg the other top contender is former Fed Governor Kevin Warsh, and current Fed Governor Chris Waller is the dark horse candidate. President Trump saying Treasury Secretary Bessent is a good option, but he likes the job he's currently doing. Meanwhile, Speaker Mike Johnson is calling for transparency by the Trump administration over the Epstein files amid backlash. This comes just days after the Justice Department said the matter was effectively closed. Johnson is a close Trump ally and has never broken away so publicly with the president on an issue. And ASML shares are lower after the chip equipment maker struck a cautious tone on its outlook for next year. Tariffs are muddying forward guidance despite positive performance by the company. Its CFO did say that lifting chip controls on China would boost demand. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. We'll catch up with Ian Lingen of BMO Capital Markets. Plus, we'll speak to Danny Berger with your morning movers with another look at the big banks on Wall Street.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
If you target inflation as your goal, it's backward looking and it doesn't comprehend all of the prices within the economy. It's just a flawed indicator. But one of the things is you switch and you say the dual mandate is to have price stability. So you need lower interest rates because of the strength of the U.S. economy. The U.S. is this giant power and people want to invest in the U.S. even at lower interest rates.
That was the former World Bank president, David Malpass, throwing his name into the ring, into the hat, to be the next Fed chair, just a little bit earlier on this program.
You heard me trying to jump in there at the end.
You had some questions.
Well, this is an argument that President Trump has put out there. There's a difference between corporate creditworthiness and sovereign creditworthiness in the developed market, in market perception. And they're saying there shouldn't be, that maybe the creditworthiness of the United States being AA or AAA should allow it to borrow at much lower rates than it currently is, and it shouldn't be tied to inflation.
That's one argument, at least. I'm not sure if it resonates with many people, but it's an argument right now.
It's not playing in markets right now, and I got a lot of response to that from people in the market who might not have agreed with it in any kind of real way, but I do think it's something worth hashing at since it seems to be something that President Trump is interested in.
Agreed. The opening bell's about 41 minutes away. Equity futures right now just about positive by 0.2% on the S&P 500, following softer than expected PPI data. With the cash open just around the corner with your morning movers, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Kicking off with another look at the big banks, rounding out this quarter for Wall Street. Solid set of results for all these names. It was about loan growth. It was about trading results. A record quarter for equity trading for any Wall Street bank came from Goldman Sachs, though. All these banks, though, not gaining more than 1%.
Not true demand-driven inflation. So I would be more focused on the service sector at this stage.
If the Fed were to cut, though, how worried are you that it would be perceived as political and actually leading to unmoored inflation expectations, i.e. higher, longer-term yields?
I do think that the Fed will need the justification of the data between now and September, which is the first earliest cut potential, to justify moving. If not, they'll have to wait till October or later in the year because they can't be seen as giving in to political pressure because it's the credibility of the Fed at stake.
If they don't cut rates, do you see the potential for a severe weakening in the U.S. economy that could lead more of a bit into the long end, but this idea that people start to realize, well, maybe these are particularly restrictive rates based on the consumer discernment that you're seeing in the data?
Well, the first observation that I would make is if they don't cut rates, that will probably bring down 10 and 30-year yields, because that implies that they're going to fight inflation more aggressively than the market is assuming at this point. So that would ultimately be a curve flattener, which probably doesn't have the same ramifications for risk assets, for equity. So I would be less concerned about economic performance and more concerned that the market attempts to front load all of the rate cuts into the June 2026 meeting when the new Fed takes the reins.
Just taking a step back, I'm still trying to process David Malpass's argument, and this is something that we've heard a lot, and I'd love your thoughts on this. The idea that the only reason why people see yields as a measure of expected longer-term inflation is because the Fed views it that way. And if the Fed changed the way they viewed it, markets would view it differently, and they would view it more as creditworthiness. The United States is going to pay its bills, so it should be able to have the privilege of borrowing at a very low rate. Do you buy that?
So that argument doesn't particularly resonate with me, frankly. I think that what that argument attempts to sidestep is the relevance of the dollar and the relevance of the dollar as the reserve currency. What we have seen during the Trump administration is the dollar has steadily declined in part because of the global trade tensions and what that means for treasuries as a safe haven asset. At the end of the day, as long as the Treasury Department continues borrowing in dollars and can print dollars, then credit worthiness should be very high. We also have the issue of the debt ceiling and those moments in which it appeared that the U.S. would choose not to pay. So there's another dynamic that suggests that it should be the global fundamentals that drive 10 and 30-year rates.
Based on everything you'd said previously, I was hearing an argument for lower bond yields on a 10-year, on a 30-year. Is it fair to say you're communicating that argument to clients? Is that what you're expecting now? Is that what you're looking for?
certainly with 10-year yields at 4.50 and 30-year yields at 5%, I see more potential for downside yields than from upsides from here. I am constructive on the Treasury market. I do think that we're entering a very uncertain period over the course of the next several months, but ultimately it will all resolve in lower rates and a familiar rate environment.
You're making really strong arguments. Essentially, a Fed distracted by goods prices, boosted by a one-off tariff shock, not paying enough attention to services prices, which are declining, so staying on hold too long, a bias to wait, forcing yields down at the long end on 10s and potentially on 30s.
The longer the Fed remains on hold, how much can you see a bid into the long end? And is it just the U.S.'s game alone to play? Or is it beholden to a global story increasingly where suddenly Japan is jerking around the U.S. market?
Well, let's finish on that. How much of a disruption is Japan at the moment?
At the moment, I think it's a good touchstone for the bond bears. We're looking around at the rest of the world, and hey, U.S. rates should be higher because Japanese rates are higher at the moment. Don't know if I buy that argument.
You're like the silent assassin you are. So measured,
Exactly
diplomatic.
what I was thinking.
Just killing the
Yeah,
bears.
I mean, just quiet, that's fodder for the bears, and they like to look at Japan.
Ian, appreciate it.
Thanks for having
Smart
me on.
arguments, thank you. Ian Lingen there of BMO Capital Markets. They're credible arguments for lower interest rates. Data can change. I know we've got limited data sets right now, but based on the data of the last 24 hours, that's where things stand.
You could see rents going down. You could see home prices going down. You could see service prices going down, which you hear from a lot of executives. There's a lot of discernment, and that's speaking to a bit of weakness.
Equities this morning positive by 0.2% on the S&P 500. The earnings holding up for the big banks on Wall Street. More earnings coming up in the next 24 hours. Coming up tomorrow, Mike Wilson of Morgan Stanley, Krishna Mamani of Lafayette College, Francis Donald of RBC, and Lisa catching up with the United Airlines CEO, Scott Kirby from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for VVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
The incidence of cancer, which is to say people getting it, is higher than it was 20 or 30 or 40 years ago. Is that because detection is better than it used to be?
All right, so the dirty secret is we have no idea. We don't collect data well in the United States. What we do know is that there's not a dramatic rise in cancer in the United States, but what we are seeing is a troubling trend is younger people are getting more cancers. That's real. We have no idea why, but we are seeing younger people, more colon cancer, more breast cancer, and other cancers in younger individuals, 20, 30, 40-year-olds, that we never used to see.
What do you think could possibly be the cause? I assume pollution or the environment in some ways?
We assume it's either something in the environment, we assume it's diet, it's ultra-processed foods, it's microplastics, it's changes in the microbiome. We really don't know.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Cool PPI boosts equity futures 30 minutes to go until the official start of trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg open interest starts right now.
Coming up, Goldman makes history as Wall Street reaps the benefits from volatile trading. Meanwhile, J&J shrugging off President Trump's pharma tariff threat and boosting its outlook. And you also have NVIDIA CEO turning on the charm in Beijing as the chipmaker opens up orders to China. All of that and more. But Shonali, let's get to the big banks.
So much going on, but the big banks, they're looking pretty good. Goldman up about 0.6% pre-market. Their stock trading business, this is equities trading plus equities financing. It's the most in Wall Street history. Morgan Stanley and Bank of America also topped estimates as traders are capitalizing on volatility. Morgan Stanley shares still down about 1.8%. Bank of America still getting a lift, keeping net interest income stable. And you're seeing the stock up, Katie, about 0.3%.
Excited to dig into those results. Also to dig into results of Johnson & Johnson beating sales expectations last quarter and also raising its full year outlook. Interesting timing here because you have President Trump's looming tariffs over the pharma industry. You take a look at shares of J&J right now up about 1.7% in the early trade, Shonali.
And we begin with bank earnings because a historic haul over from Goldman. Bloomberg's chief Wall Street correspondent, Sridhar Natarajan, is going to join us to talk about how Goldman achieved this. Because on one hand, yes, equity trading coming in where it was $1 billion more for the whole unit than what JP Morgan bought in. How much are they leaning on financing? I think it matters because there are a lot of questions about sustainability around trading and how much money these big hedge funds really need to do their job on a day-to-day basis via leverage.
Look, I'll hit the sustainability point first because that is something that is extremely important to investors. They pray at the temple of repeatability. So every time Goldman Sachs has good numbers, especially in its trading businesses or, its old school asset management business, the merchant bank business, investors would always come out and say, that is great, but can you repeat it? I think Goldman Sachs today will tell you, especially within its global markets business, within its trading business, is that yes, it is repeatable. They have been repeating this for successive quarters now. And even when some of the market craziness is extracted out of it, the level where they will settle down eventually will still be higher and much more respectable than what analysts have feared. And when you post a $4.3 billion equities quarter, that is incredible because it wasn't long ago, Shonali, when you used to obsess over these numbers at Morgan Stanley and Goldman, that a $2 billion quarter was considered good. That fell by the wayside, and when we had the $3 billion quarter, now Goldman's gone 2 straight quarters at above $4 billion, and that is a very important benchmark.
Well, sure, you touch on a big question out there, whether or not we can see these numbers repeated. You say we can. It's interesting to take a look at the Morgan Stanley results, too. You think about in June, we heard from CEO Ted Pick describing the quarter as basically a tale of two. It started slow, and then it paused, and now it's picked up. But it seems like the consensus is that it's sustainable, these big beats that we're seeing in trading.
Let's acknowledge the fact that the first 6 months of the year, there has been a lot of headline risk associated activity that has prompted a lot of trading. That is something where intermediation, where the banks sit in the middle of all these trades, has been in great demand. So if you take some of that madness out of the markets, where do we settle down? Does the $4.3 billion end up at $3.3 billion? Would that be acceptable? Go back to these very same bank analysts, perhaps 2 years back, and ask them if this bank or these banks were to consistently post $3 billion plus equities quarters, would that give you confidence? Would investors look at it and give it a higher valuation? And the answer undoubtedly would have been yes.
I just want to cite some things coming on in the call as well, because Ted Pick at Morgan Stanley is talking about the opportunity with a high bar for inorganic growth opportunities as well. We should cite that the stock decline that we're seeing, they were trading at almost JP Morgan type price to book multiples. Really quickly here on Bank of America as well, they did not raise their net interest income guidance when JP Morgan did. What does that say about the prospect of the Main Street businesses? We know Wall Street is doing well.
Look, I think the Main Street businesses have been resilient, and that's what you've heard from banks like JP Morgan, Wells Fargo, Bank of America, and that's not the real problem that they're contending with, but they do have certain idiosyncratic problems, especially their hold-to-maturity book that was such a big issue 2 years back. It's not something that's gone away. It still soaks up a lot of their balance sheet, and that has made it harder for them to meet their NII targets. They have to divert resources from elsewhere to get to those NII targets. What it has meant is it's become harder every quarter to sort of meet the targets, beat them, and raise expectations, while also weighing down the other businesses, their Wall Street-focused businesses, because if you look at Bank of America's numbers, they've really fallen behind JP Morgan and Goldman Sachs and Morgan Stanley in a pretty appreciable manner. Even though quarter on quarter they're doing well relative to themselves, relative to the competition, it's not great reading.
All right, Shri, really appreciate the breakdown here. A lot to keep pulse of, but that's exactly what you're doing. That is Shri Natarajan, our chief Wall Street correspondent for Bloomberg News. Those are the big banks. Let's get to Big Pharma. Also in focus this morning after President Trump says he's likely to impose tariffs on pharmaceuticals soon, with semiconductors also in the firing line.
Pharmaceuticals will be tariffed probably at the end of the month, and we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff.
So that was the president speaking yesterday, and this morning, J&J, it actually raised its full-year outlook despite concerns around tariffs. Let's make sense of it all with Bloomberg Health reporter Damien Garde. And Damien, J&J, to see them boost their outlook, they're a pretty conservative company when it comes to the guide. So square the circle here. If you have J&J boosting its outlook, and you also have pharma tariffs potentially coming at the end of this month.
Yeah, it's interesting. Not only are they conservative, but they are typically a bellwether, frankly, in healthcare because they report earlier than other companies in the space and are the largest multinational firm in pharmaceuticals and medtech. I think the best way to look at it is, having spoken to J&J, they look at what the president says and what is enacted there's often a chasm between those things. So the tax bill that was passed recently, the tax cuts from 2017, these are the kind of permanent things that J&J is building its business on and making investment decisions based upon. The looming specter of tariffs, at least they've said, is less front of mind for them. Now, that being said, they, like many companies in pharmaceuticals, announced sweeping plans to invest in the United States that was, I think, pretty transparently a sop to the White House to say, look, don't tariff us. We are investing in the United States. We want to make medicines in the U.S. for American patients, but massive biopharmaceutical manufacturing facilities are not the kind of thing that you can just put up overnight, so you will need to give us time. So this latest escalation from the president suggesting pharmaceutical tariffs would come by the end of the month at a low level with these kind of undefined terms, that does escalate, I think, some of the anxiety among analysts and investors, but J&J itself seems to be as confident as ever, looking forward and saying, basically, we can make and exceed the numbers that we've set out based on the policy environment as we understand it.
Well, Damien, let's talk about the broader industry. Okay, you have J&J positioning confidently, but when it comes to that ramp up, is 12 to 18 months long enough to actually build these facilities in a meaningful way and shift back production to the U.S.?
I would say in order to stand up a new factory that would make complicated injectable medicines, that's a 3 to 5 year process. But what we know companies have been doing is basically onshoring the product that they will need for the United States. Merck has said that Keytruda, their blockbuster cancer medicine, which is largely made overseas in Ireland, they've brought a ton of it over to the United States such that they can supply American patients through next year. We know Pfizer has done similar things and J&J as well. So these companies have had a lead time to prepare, at least to satisfy the demand, with the longer term goal, or the longer term promise, I should say, that they've made to build more manufacturing here in the US. But they seem to be covered for the short term. And I think that possibly explains why they have largely been bullish in the face of this constant threat of tariffing.
Damien Garde, we thank you so very much, of course, from Bloomberg News. In the next hour, we're going to speak with Johnson & Johnson's Chief Financial Officer, Joe Woke. Let's turn to tech. NVIDIA CEO Jensen Huang says the U.S. will soon approve exports of its H20 chip to China, which is reversing a multi-billion-dollar write-off due to previous chip curbs. Take a listen.
the things that we wrote off might be harder to recover, but most of the things that we put on reserve will not be scrapped permanently, was not scrapped permanently. And so we'll compare what customers would like to buy now versus the inventory that we have, and then we can figure that out. It's probably not 100%, but it's not 0% either.
Joining us now for more, Michael Shepard, Bloomberg's executive editor for technology in Washington. We talked just a day ago about the billions at stake, the $4 to $5 billion in a quarter and the $8 billion or so projected. But how much uncertainty is there still when it is coming down to NVIDIA's relationship to China, given the push-pull that we've seen from the Trump administration?
Well, it's a great question, Shonali, because there is still a lot of uncertainty overall surrounding the U.S.-China relationship and how much Washington will relent toward Beijing when it comes to this question of export controls governing advanced technology. But we did get a signal, at least for NVIDIA, that was quite favorable. And the company says it expects to receive licenses allowing the resumption of sales of its H20 AI chip in China very soon from the government. Now, the question is this. Does this relenting by the government, does this relaxation of curbs on the H20 apply to the existing inventory that NVIDIA had compiled of the H20, or does it go beyond that? And how many orders more are backed up beyond this? Jensen Huang says he has plenty of orders already on the books that predate the ban, but what is coming next down the pipeline? So we want to see also how quickly these licenses are actually approved, whether it will be a rubber stamp process, and how far it will go. Will the U.S. government at some point put a cap on it too? Because the U.S. government has tried to restrain China's growth in artificial intelligence, and NVIDIA's chips, as we all know, are really a key to that globally. So we'll be watching this very closely from the government end here, Shonali.
Absolutely. So NVIDIA, AMD, they're one story. They broadly fit together when you talk about these licenses. But I want to talk about ASML, total wipeout in shares this morning, down 8% or so. You think about what they reported, really hedging their growth outlook next year because of the tariffs, because of the trade war. So it's not a story that you can apply just blanket over the entire chip sector.
Well, that's right, Katie, because when you look at ASML, it really is a very different story. They are still grappling with this cloud of uncertainty, and it's stoked much more by tariffs. They are still awaiting Donald Trump's decision. We heard him speaking just now, yesterday, addressing this question of not only drug tariffs, but also tariffs on semiconductor imports into the U.S. And if you think about it, the tariffs will not just apply to the chips, but also to the chip-making equipment. And what ASML makes is a huge input into those factories. It's very expensive, and a tariff on that could restrain growth in that area for them.
All right, Michael Shepard, always great to speak with you. That is Bloomberg's Michael Shepard joining us from D.C. for the intersection between politics and the tech sector. And coming up, more on Goldman's historic haul. We'll digest bank earnings with Gerard Cassidy of RBC Capital Markets. This is Open Interest.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
America has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment, and it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
And now to high interest, a look at what's making headlines around the world. Mining giant Rio Tinto says that U.S. tariffs on its Canada-made aluminum generated gross costs of over $300 million in the first half of the year. And it's another sign of how President Trump's trade agenda is shaking up metal supply chains. And I'm watching private equity stocks. They are rallying pre-market on news that the Trump administration is finalizing an executive order that would pave the way for 401k retirement plans to invest in private equity. President Trump could sign the directive soon, but details are being discussed. No date is set for an announcement, and many of these stocks have actually been down on the year, so getting relief on the prospect of these retirement plans. And MasterCard is throwing its plastic in the ring to try and woo big spenders. It's announcing a higher tier of reward cards called the World Legend category. The new perks includes priority access to dining reservations, ticket pre-sales, streamlined airport access, security access. Katie, you might remember JP Morgan just made their card more attractive too. So you're looking at a lot of competition in this card space for that high spender.
Absolutely. We know it's been heating up, and we'll continue to follow that story. But let's get back to the big story of this morning. Bank earnings showed trading revenue topped estimates at Bank of America, Morgan Stanley, and Goldman Sachs. But the crown goes to Goldman after the bank's equities traders delivered the best quarter ever in Wall Street history. Let's unpack those numbers now. Gerard Cassidy, he is RBC's head of U.S. bank equity strategy and large cap bank analyst. Pleased to say he joins us now. So trading across the board seems very, very strong, Gerard, but what specifically went so right over at Goldman Sachs?
I think what you have to do with Goldman Sachs is turn back the clock to early 2020 when David Solomon introduced a program to deepen the relationships with their top institutional clients. At the time, they wanted to increase the penetration to be the top 1, 2, or 3 broker for those top institutional clients. Now, of the 100 that they identified, I think the number was in the mid-50s, and today that number is closer to 80 or 90, and they have increased from 100 clients that they've identified where they want to be the top 1, 2, or 3 broker to now 150 institutional clients. So it's been this concerted effort, the one Goldman Sachs approach of multiple products to these clients, and I think that's a factor behind the strength in your equities business.
How sustainable are these trading revenues? I think it's really interesting. I took a look at the value at risk, right? You have to go a little deeper to take a look into those, I realize. But you saw generally top line VAR at JP Morgan actually declined while it rose at Goldman. Are they willing to take on more risk? And what does this all say about risk appetite in such a volatile environment, Gerard?
Certainly, Goldman has done a great job over the years of controlling risk. They have very strong controls and procedures. And I think by taking on more risk in this environment, it is a risk-on environment post the April time period. And they can manage that. But we have to remember that the markets obviously are a major factor behind the investment bank's trading revenues, and increased volatility is good for trading. It's not as strong for investment banking revenues, but for trading, you want volatility, and we certainly had that at the start of the quarter. So I think that is one of the factors why Goldman and others are putting up better trading numbers this quarter, is because of the increased volatility that the markets experienced in the second quarter.
And you certainly found that volatility at the beginning of April with Liberation Day and then the walk back. But Gerard, I want to get your thoughts on the conversation around net interest income, because you had Bank of America surprise a little bit on that measure this morning. You think back to yesterday, JP Morgan coming in a little bit soft. Where do we stand on that metric?
Sure, Katie. When you look at the big banks, clearly net interest income is a big component of revenue, not so much, of course, for Goldman or Morgan Stanley, but for the money center banks it is. And I would say that when we look at it, we have to take into account two factors: loan growth as well as what interest rates are doing. And if we expect to see cuts at the short end of the curve and we get a steeper yield curve, that's going to help net interest income growth as well as loan growth. The other factor for both Bank of America, JP Morgan, and all the others is the repricing of assets that were purchased at lower yields in 2020 and 2021. And Bank of America certainly took duration risk back then, but now is delivering incremental improvement in their asset yields as those assets are renewing and are being reinvested at higher yields. So that's another factor for net interest income. But what we really need to see is loan growth.
Gerard, it's all about the Morgans in so many ways. If you look at the price to book ratio of these stocks, they were sky high. I was kind of watching them compete yesterday, and you actually saw Morgan Stanley's valuation on that metric rise above JP Morgan for a moment. This morning, you're seeing a decline in Morgan Stanley's stock. Is that valuation alone? They fell below Goldman in equities trading. You know, is there anything not to like, really, in these numbers?
No, certainly Morgan Stanley had very strong numbers. And, you look at the valuations of these stocks, and Morgan Stanley is essentially trading around 3 times tangible book, as is JP Morgan. I think when you look at the earnings call and you read the transcript, Morgan Stanley talked about inorganic growth, which means acquisitions. And I think that was the trigger that may have pushed the stock down, because investors know the initial purchase of another company often is dilutive. And not to say that Morgan Stanley is going to buy something that's dilutive, but that's what people worry about. And I think that was a factor in where the stock is trading in pre-markets this morning.
Fascinating. A lot of questions about existential things like mergers, like stable coins we're coming up to. Gerard, we thank you so very much for joining us in this busy earnings season. That is RBC's Gerard Cassidy. And later today, catch an interview with Bank of America CEO Brian Moynihan. That's at 2:30 p.m. New York time. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back to Open Interest. We are minutes away from that opening bell, and here is your setup. Green on the screen. The S&P 500 up by about 0.2%. The NASDAQ 100 a little bit higher. It's the small caps that are in the lead right now. Of course, we got pretty much unchanged PPI at 8:30 a.m. That is helping out the small caps. Let's take a look under the hood here. Some really interesting individual movers. A lot of that stemming from Elliott Management. You had HPE making a pact with the activist hedge fund, going to work with the company and form a strategy committee. Not moving too much, but this caught my eye because you also have Global Payments really rising this morning. Also want to report that Elliott Management has built a sizable stake in the company. They're busy over there.
Yeah, Elliott is known as the most feared activist investor, right? What Paul Singer wants, Paul Singer gets. And Global Payments is an interesting one, Katie. HP, of course, this is on the back of that new strategy group, as you say, but Global Payments, we don't actually know what the demands are yet. Yeah. But they announced a massive, massive deal to acquire WorldPay a little earlier this year. So investors are going to want to know what that's about.
Absolutely. And we also had MP up there on the board. Just want to squeeze that in the last 30 seconds because, boy, this company has been on a tear, operating the only rare earths mine in the U.S.
270% gain on the year.
Just wild. We'll walk through all the action at the opening bell up next. Don't go anywhere. This is Open Interest.
Another art museum of the Guggenheim. Now, Louvre's big enough. Why do you need a Guggenheim as well, right next door?
I think it's a great question. I think the beautiful thing about the UAE and Abu Dhabi is we live with over 200 nationalities. And in doing so, they have become a part of the country's and the city's fabric. And we need to celebrate that. So we need to celebrate everybody's identity, everybody's background, everybody's heritage, everybody's history. And what a beautiful way in doing so in these beautiful institutions. These museums are educational institutions and they're community institutions. So we wanted to curate really a story where you come to Saadiyat Cultural District and you, if you allow me to curate the story, you start off at the Natural History Museum. And at the Natural History Museum, you get a glimpse and you get an understanding of how we came to be, how our Earth came to be, how our universe came to be, from a scientific perspective. Once you leave the Natural History Museum, you go to our National Museum, the Sheikh Zayed National Museum. There, you understand the history of this great land. Not just the history of the country, but the people of this land that have been a part of this land for over 300,000 years. You get a glimpse of what the past and the present and the future looks like here in the UAE. From there, you maneuver yourself to the Louvre Abu Dhabi, which is a beautiful universal museum. It is universal in its thematic approach. So there, you basically see a part of you on an equal pedestal with the entire world.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
All right, we are moments away from the start of trading on this Wednesday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You take a look at where we stand as we start to open this market. The S&P 500 a little bit higher in the pre-market right now. This is broadly what it looked like yesterday morning at this time, too. Even better, and we managed to finish in the red. So don't hold your breath. We'll have to see how it develops. You can see that the bells are ringing right now. We have Aura over on the NASDAQ. When you take a look at the New York Stock Exchange, this is an interesting one. This, of course, is Donald Trump Jr.'s company, 1789 Capital, that he's involved with. I believe this is a SPAC, and it's coming public today. The bells are ringing. Everyone's clapping over there. So we'll track that one. But let's get a look at this market and how we're opening up. And Shonali, I know you are all over those big banks.
Yeah, SPACs, deals coming back. They're giving a boost to the banks. But Goldman actually is the only one still up on the morning. They reported the best trading revenue at the equities business in Wall Street history of any bank. And you are still in the stock actually fluctuating. Pretty interesting. There's a lot of questions about whether those trading gains are sustainable. Morgan Stanley talking about the potential for mergers and acquisitions. The stock now down almost 2%. More than that. Fluctuating as well, though, at the market open. Bank of America still down about 3/10 of 1%. They're all trying to capitalize on this volatility, Katie, but let's see how much juice there is left to squeeze out of the Wall Street businesses.
Absolutely. It always boggles me, the stock reaction to these big bank earnings, because Goldman having its best quarter ever when it comes to trading in Wall Street history, and the shares are down. But we'll watch how that one develops closely. Let's also talk about pharma, because Johnson & Johnson coming out this morning, beating sales expectation last quarter, also raising its full-year outlook, which is interesting because you have President Trump's looming tariffs over the pharma industry. We'll unpack that with CFO Joe Wolk, who joins Open Interest next hour. And on the topic, let's talk about earnings season overall, because expectations are so low that any misses will be heavily scrutinized. Karen Pei of Fiduciary Trust says that we would characterize this as a show-me market environment. Valuations are high, and we expect them to be tested. And I'm pleased to say that joining us at the desk now is Karen Pei. She is head of portfolio management and equities at Fiduciary Trust International, a Franklin Templeton company. Karen, great to have you with us.
Great. Thank you, Edie.
So I thought that note was really interesting because you take a look at yesterday's reports, for example. You had Wells Fargo getting punished for cutting its guidance, BlackRock also getting punished for missing its inflow estimates. It sounds like you're saying we can extrapolate that to the reaction function for this entire season.
Yeah, I think that that's right, because we are coming into a market where the market currently is trading at high valuations. So any misses or any sort of disappointments in terms of guidance is probably not going to be taken lightly by the market. And so I do think that investors need to be patient as they're thinking about, buying opportunities. I think patience is warranted, and valuations really do matter. And the opportunities are probably going to be in the securities that are mispriced or undervalued in this marketplace. So stock selection is key here.
When you say mispriced opportunities, how exactly are you looking for them? Because some of the more hard-hit areas in the market are the ones that are either more tariff exposed or consumer exposed, as investors are trying to get past any potential worries about the U.S. consumer. So what are you comfortable then buying that's beaten down?
Yeah, you hit it right on the head of the nail in terms of the economy being sort of like a two-track economy, and we do have a two-track market. The market has really rewarded those companies that have demonstrated growth. namely, a lot of the technology companies. But the stocks that are lagging, or the parts of the markets that's lagging, are the ones that are negatively impacted by tariffs. Consumer stocks, for example, retailers. I think that those companies are probably going to be the ones that will give us a little bit more clarity around how tariffs will be handled, and perhaps, how much of tariffs costs they would be potentially passing on to consumers. I do think that consumer spending is, vulnerable going forward. They've been resilient so far, but we are seeing, that there is sort of this bifurcation in terms of the consumer. Even if overall consumer spending is resilient right now, we're not just, we're just not seeing it unless you look under the hood.
It's interesting. It kind of reminds me of the conversation we were having around Delta earnings. Remember that K-shaped recovery? You had international premium doing well, the back of the plane not so much. And with all that in mind, Karen, I mean, could you build a case for sort of shying away from consumer-focused companies and sort of gravitating towards the companies that other businesses spend money on? I'm thinking about all the CapEx spend that's going into the likes of NVIDIA, for example.
Yes. So that's been an ongoing trend, and that has been supporting a lot of the technology and AI sort of related names. We see that also helping lift some of the industrial companies that are tied to data spending, data center spending, and infrastructure spending. We see it, also impacting some of the companies that are within the utility sector, right? So there is this underlying theme in terms of what companies are benefiting from CapEx. And I think that that's probably a smart way to invest until we start to see signs of CapEx slowing down. That will probably continue to be a winning strategy. But I do think that in terms of what's underappreciated, when we look for valuation in the marketplace, I do think that, looking for companies that are showing strong cash flow growth, free cash flow, dividend yield. You mentioned J&J just before, and there's a company that is looking to be more innovative. There's a change in management, and I think that those are some of the catalysts that we want to try to identify in this marketplace, where it's not appreciated by the market based on the valuation, but that there could be some catalysts that could drive that valuation up.
So what role is the macro playing? Because we also had PPI data this week, we had CPI data, and retail sales coming up. How much is this a market in need of a rate cut to kind of fuel a little bit more excitement about some of those consumer vulnerable sectors, let's say?
Yeah, I think that if we should see that happen, it would definitely boost the market and maybe perhaps support higher valuations if we see rate cuts that are greater than what the market's currently expecting. Certainly the Trump administration is pushing for that. But, I do think that we have a market and a financial market that is heavily dependent on liquidity. And, I would look for signs of potentially any signs of distress in the credit markets. We're seeing right now, for example, from the bank earnings that loan growth isn't as strong as it should be. A lot of the financial institutions, the bank earnings are lifted by trading, right? So that may not be sustainable. And a lower interest rate environment would definitely be a boost for those companies.
All right, Karen, that's a good place to leave it. Always great to get some time with you. That is Karen Pei of Fiduciary Trust International, a Franklin Templeton company. Let's take a look at where we stand on this market. We're just about 7 minutes into the session. And again, I was saying at the top of this block that this is sort of buyer beware. We were higher at this point yesterday morning. We closed down 0.4%. But what is different right now is the breadth. You take a look at the breakdown of the companies moving in this S&P 500 right now. You have nearly 400 names in the green. That is a good sign. You have 116 or so in the red. And you take a look at what's leading right now. It's a real mix. You have Apple up at the top on a points basis, Johnson & Johnson rising on earnings news and a forecast raise. And then you have Tesla, JP Morgan trading places right now. You take a look at the downside. There are some big names that we need to keep an eye on. Amazon, Microsoft, Broadcom, Meta, Canada, all falling a little bit today, maybe weighing on some of the enthusiasm. And that's what you're going to see on the sector breakdown as well. When we take a look at the bars and how they're doing right now, you can see more green than red. That's a good sign. Real estate, healthcare, financials, all bringing this market higher. The weight on the downside, tech might go negative today. Then you take a look at materials and consumer discretionary, down about 0.1% Shonali, but overall, really strong breadth signals right now.
Very strong, and we'll see if it holds up throughout the trading day. Really mixed trade under the surface a little bit too. So we will keep an eye on single stocks as well. But coming up, the single stock we're looking at is the one that's open for orders. NVIDIA CEO turns on the charm in Beijing. We're going to give you the details of his visit to China next. This is Bloomberg Open Interest.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back to Open Interest. A check on the stock market right now. We're about almost 13 minutes into the session. The S&P 500 trying to hold on to its early gains, but then you take a look at big tech in the NASDAQ 100 slipping into the red. We know that Microsoft, Amazon, Meta, etc. are lower today. That is certainly bringing some enthusiasm out of this market, but not when it comes to the small caps. The Russell 2000 higher by about 0.6% right now, maybe helped by that economic data that we got at 8:30 this morning, showing cool PPI, unchanged PPI, certainly a welcome relief for some of those smaller companies. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Palantir getting upgraded over at Mizuho on strong AI adoption. The firm says that Palantir's robust growth story appears intact. And remember, this stock has nearly doubled this year. Next up, we have Valero Energy and Phillips 66 getting cut over at Citi as analysts expect that downside risk for the oil and gas refiners to remain in the second half of the year. Shares down just a little bit. And we end with the chip and software design company ARM Holdings getting upgraded to a buy over at BNP Paribas Exane. The analyst says that there is significant upside to this stock, and you can see shares right now higher by more than 3%, 2% rather, Shanali.
And NVIDIA CEO Jensen Huang is now saying that approvals from the U.S. to send its H20 semis to China is expected soon. Katie, you've been keeping such a close eye on this story. Huang commented to reporters on his attempts to mitigate losses after President Trump blocked sales of the chip model.
Some of the things that we wrote off might be harder to recover, but most of the things that we put on reserve will not be scrapped permanently, was not scrapped permanently. And so we'll compare what customers would like to buy now versus the inventory that we have, and then we can figure that out. It's probably not 100%, but it's not 0% either. Tariffs, you know, the world is reconfiguring itself, and we are a company, and we just have to adapt to whatever the world's trade and tax and tariff conditions are. There were trade, taxes, and tariffs before I came into NVIDIA. There will be trade, tariffs, and taxes after I leave NVIDIA. And so this is just this is something we all have to adapt to. But the very incredible thing is, you know, NVIDIA is a very adaptable company. Our supply chain will have to adapt, and we will find a new way. Okay, so in the long term, it always comes back to this. Do you make products and technologies that are important to the world? Are you building things with great craft and care that customer deliver and receive benefits? And are you doing something that really impacts the world? And if those things are true, everything else will solve itself.
And joining us now, Mandeep Singh, Global Head of Technology Research at Bloomberg Intelligence. One major question that remains for me is how much certainty is there to the return of billions in dollars in revenue that would otherwise have been written off?
Well, so it's unlikely that they will see any, recoup of the $8 billion in write-downs they had for the guide, but it is very plausible that second half may get a lift from additional China sales, and 2026. That's the big kind of focus for everyone, because you don't want growth to go from 60% to 15, 20%. It'll be much better if the growth is 25 to 30%, and that additional lift can come from China in this case.
So this isn't something we're going to see necessarily in NVIDIA's next earnings report, but something to look forward to, and we know that the stock market is a forward-looking animal. I want to talk a little bit about ASML. We were having this conversation with Mike Shepard that this isn't a blanket story, potential China relief that you can apply to the entire industry. You take a look at ASML still dealing with some of these concerns, really restraining their growth outlook too.
Well, in the case of ASML, look, they have exposure to TSMC, and we know TSMC is almost 50% of ASML's revenue at this point, in terms of the tool sales. But they also have exposure to Samsung and Intel. And Intel being in cost-cutting mode, Samsung doing poorly. So that is where, there are puts and takes when it comes to ASML's guide. But the bookings number was strong. Gross margin went up. So all indicators point towards increased demand for their AI-exposed tools, and they're just being conservative at this point.
I have a question about the U.S. strategy and the uncertainties around it, because you have the U.S. expected by Jensen Huang to approve those first batch of U.S. licenses for those H20 chips to China. But here's what's still uncertain. How many licenses are going to be approved? Then there's also whether the permissions will go beyond existing inventory for NVIDIA and include orders of new H20 production. What does that mean in terms of financial uncertainty moving forward?
Yeah, look, when it comes to NVIDIA, we know they are on their Blackwell architecture. So these are the Hopper chips, the scale-down configurations. And they're about to release their new Rubin architecture as well next year. So clearly, if you're a customer in China, you're looking forward to what else will I have access to after H20s. Yes, they may have H20 shipments from NVIDIA, but then these configurations continue to get better in terms of power and efficiency. And that's what will determine, what kind of sales NVIDIA will have in China and what it means to gross margin. At the end of the day, the latest chips that NVIDIA sells are gross margin accretive. And, that's what you want when it comes to NVIDIA having that higher portion of the, the latest chips that they're making.
So NVIDIA China is undoubtedly important, but you think about the competitive landscape in China specifically, and Jensen Huang has made the point that they've lost market share to the likes of Huawei and other homegrown competitors here. I think the number that he cited was their market share was 95%. It's gone down to 50%. Is the genie out of the bottle, or can they actually grow their market share once again? Maybe not to 95%, but
yeah, I mean, even in the U.S., when you look at their share in inferencing, it's not close to 80 to 90%. That was the case a couple of years back when training was a predominant kind of force when it comes to AI. So clearly, the hyperscalers making their own chips, whether it's Google or Amazon, is having an impact even in U.S., and the same is applicable in China. I mean, there are hyperscalers, and then you have players like Huawei. So clearly, I think NVIDIA won't have 80, 90% share, but this is a growing market. We're talking about $1 trillion in data center spending. So even if NVIDIA has 60, 65% share, you're still talking about, 500 billion plus in revenue, if it turns out that data center spending will be close to $1 trillion in the next 5 years.
Mandeep, thank you so much for joining us this morning. That is Mandeep Singh of Bloomberg Intelligence, with a lot changing geopolitically and therefore a lot changing for some of the hottest trades on Wall Street. Now coming up, another hot trade, rare earth stocks surging on the Apple deal with MP Materials. We're going to talk about what the deal is all about next. This is Bloomberg Open Interest.
Loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Welcome back to Open Interest. Let's take a look at the stock market where gains are fading right now. The S&P 500, I'm going to go ahead and call that unchanged even though the color is green. The NASDAQ 100 is already there. A big reason why is right behind me, actually. NVIDIA down a little bit. Again, this is such a huge company that just losing its gains really putting a weight on the index. I want to talk about some of the gainers today, though. Johnson & Johnson, as we've been speaking about, beat and raised quarter, and then you take a look at the rare earth companies as well. MP Materials has been absolutely on fire. It's backed by the Pentagon, and now it has a deal with Apple as well. So all the stars aligning. 2.7%. You might say that's not that much, Sonali, but consider year to date, its gains are approaching 300%.
It's absolutely an incredible surge. And to your point, Apple had struck that $500 million deal to buy rare earth minerals from MP Materials, and it's sending rare earth stocks higher. We're going to bring in Bloomberg stocks reporter Matthew Griffin, who's been following the story. How many rare earth stocks are there, honestly? I mean, is this a trade that is kind of hard to find to begin with, given that rare earths can be hard to get as an asset?
Absolutely. This is not an easy sector to get exposure to if you're a U.S. stocks investor. MP Materials actually has the only operational mine for rare earth metals in the U.S. That's in California. And so I think that's why you look at some of the other names like Ramaco Resources. Their connection is actually that they're developing a coal mine that will produce rare earths sort of in addition to that. And then USA Rare Earth is another name that is actually currently building a magnet factory, which they say is going to be online commercially next year. So basically anyone with any connection to the sector and plans in the sector is getting a boost as investors look for way in.
And the ETFs are coming too. I can smell it, a whole batch of new filings on rare earths. But you make the good point. If you're looking for a pure play, it's really MP Materials, the only U.S. mine for rare earths. And give us the context here, Matt. When it comes to rare earths, we know that the U.S. is really eager to build out our supply. And I feel like maybe the average investor who's just getting socialized with the concept doesn't appreciate how important these are.
Yes, so I mean, at a high level, we all, it's a safe bet, use rare earths every day. They enable the colors in your smartphone screen. They're used in catalytic converters in cars. They're used in electric vehicles. You need hundreds of pounds of them to make an F-35 fighter jet, so the U.S. government really cares about them. And their mining, and especially their refinement, is dominated by China, which has become an issue during trade tensions when tariffs have ratcheted higher between the two countries. China has actually used export controls on rare earths as a way to gain leverage.
And that goes a long way to explaining why the Pentagon is also backing MP Materials. Matthew Griffin, great reporting as always. That is Bloomberg's Matthew Griffin. And coming up in the next hour on Open Interest, it's a big one. We have the CEO of MoneyGram joining us on the possibility of an IPO. We'll also speak to the CFO of Johnson & Johnson. Remember, a beat and raise quarter, even with the looming threat of pharma tariffs. And we'll also speak to Dwight Scott. All that and more coming up. This is Open Interest.
is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were gonna probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is gonna get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news wherever and whenever it happens. I'm Anne-Marie Hordern in Alberta, Canada, and this is Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. President Trump's just weighed in on growing calls for the Attorney General, Pam Bondi, to release files on the late pedophile Jeffrey Epstein. In a new Truth Social post, the president says, quote, radical left Democrats have hit pay dirt again. He calls it the Jeffrey Epstein hoax. Among GOP Republicans who want the American people to see more, House Speaker Mike Johnson. Correspondent Scott McFarland.
Trump supporters have accused Bondi of withholding Epstein records after the Department of Justice released an unsigned memo last week saying the convicted sex offender didn't have a client list and they wouldn't disclose any more information. House Speaker Mike Johnson, a strong Trump ally, is calling for more transparency.
It's a very delicate subject, but we should put everything out there and let the people decide it.
An arrest in Los Angeles after the double murder of American Idol executive Robin Kay and her husband Thomas DeLuca. LAPD Lieutenant Guy Golan.
When the homeowners returned back to their residence, a violent struggle ensued between them and the suspect who was already inside their home, which resulted in the victims tragically losing their life.
Police believe the 22-year-old suspect entered the house through an unlocked door. An Israeli-backed American aid group says 20 Palestinians were killed today in the crush of a crowd at a food distribution site. The BBC's Yolande Nell reports from Jerusalem.
GHF put out a statement saying it was heartbroken by this tragic incident and described a chaotic and dangerous surge. It blamed agitators. It said there was credible reason to believe that they were people who are armed and Hamas affiliated among the crowd.
They're bracing for the possibility of bad weather in the Gulf. CBS meteorologist David Parkinson.
This is a very moisture-laden system, so 4, 5, 6, 7 inches of rain possible in portions of the Gulf Coast, particularly Louisiana and maybe the Gulf Coast of Mississippi as we go to close out the week from this tropical disturbance.
There's a new flash flooding risk in the Northeast after New York City got socked with half a foot of rain in just 2 hours Monday. 2 people in New Jersey died after their car was swept away by rushing water. A former president and first lady are finally putting the rumors to rest.
It's my husband, y'all. She took me back.
Michelle Obama welcomed the former president with a big hug on today's episode of her IMO podcast.
Wait, you guys like each other?
She assures her co-host brother, Craig Robinson.
There hasn't been one moment in our marriage where I thought about quitting my man.
She says they've had ups and downs, but she wouldn't be who she is without him by her side. This is CBS News. There are new rules for tourists in one Italian hotspot.
Frustrated at how visitors behave, the charming seaside town of Portofino has brought in a new dress code and more. As of yesterday, tourists are no longer allowed to walk barefoot, topless or in swimwear through the Italian Riviera town. Drinking in the street is also banned, as is sitting or lying on public paths, walls and parks. Portofino has a year-round population of just 400, but sees an influx of 100,000 visitors each year. Elaine Cobb, CBS News.
A big hunk of meteor will be auctioned off in New York today. Sotheby's Cassandra Hatton.
This is a massive 54-pound Martian meteorite that landed in the middle of the Sahara Desert.
It's expected to bring in as much as $4 million. The Dow is up 70 points in early trading. S&P ahead 1, NASDAQ down 76. This is CBS News.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube as well. Lisa Mateo and Paul Sweeney with you. Coming up, we're going to check in with Brendan Murray, Bloomberg Global Trade Editor, get the latest on the tariffs. That August 1 date, President Trump, it's going to be a pretty hard date. Woo Jin Ho, Bloomberg Intelligence, Senior Technology Analyst. We're going to talk about HPE. There's got a pack there with Elliott Management in terms of shareholders. Yelena Shulyatieva, one of our favorite economists, she's over at the conference board. We'll get her thoughts on some of this inflation data we've seen over the past couple of days. The PPI data that came in today, pretty darn benign, coming in below expectations. And Allison Williams, the hardest working analyst at Bloomberg Intelligence over the past couple of days. She covers all the big banks, and we'll wrap it up here. We heard from Goldman Sachs. Bank of America was today. Morgan Stanley was today. So we'll get the latest on the big banks. So a lot to deal with in terms of the earnings front, as well as the economic calendar, as well as the news flow coming out of D.C. We're on top of it all. Right now, let's kick it all off with Charlie Pellet.
Thank you very much. And here's what's going on. All three of those bank names that you mentioned, Paul, they are trading lower right now. I'll have more in just a moment. This Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges, no conflicts of your interest. Learn more at ibkr.com/RIA. We got the S&P 500 index waffling, shuffling between small gains and small losses, a decline in chip makers keeping broader gains in check as traders parse cooling producer prices and a string of profit updates from those big banks. Right now, the S&P 500 index flat on the day, down under 1/10 tenth of 1%, down 4 points, 62.39. The Dow up 22, gain there of 1/10 of 1%. NASDAQ down 40, a drop there of just about 0.2 of 1%. The 10-year yield at 4.44%, the 2-year 3.92%, and the 30-year 4.97%. Gold up less than 0.1%, 33.26 the ounce. West Texas Intermediate crude down 1.1%, and Bitcoin back at $118,528. So we did hear from Goldman Sachs, Morgan Stanley, Bank of America this morning. All three are lower. As for the bank macro backdrop, Gerard Cassidy is head of U.S. Bank Equity Strategy at RBC Capital Markets, and he was a guest this morning on Bloomberg Surveillance.
A 3.5, 3 3/4 Fed funds, 4.5, 10-year is very positive for the banks. In fact, you have to go back 20 years to find that kind of environment where the Fed funds rate was over 3% with a positive slope. So that would suggest regional banks could, which have lagged the money centers, could be the play for the next 6 to 12 months.
Gerard Cassidy of RBC on Bloomberg Surveillance. Goldman Sachs after earnings down 1/10 of 1%. Morgan Stanley after earnings down 2.3%. Bank of America down 0.3 of 1%. By the way, we got its CEO Brian Moynihan coming up 2:30 p.m. Wall Street time. And briefly in the metropolitan New York area, word of delays with New Jersey Transit reporting rail service delayed up to 60 minutes in and out of Penn Station. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie, I mean, you're killing
You
it.
just ruined my day.
Well, I just got you guys brought it up. Just a couple of more details we got crossing on the Bloomberg here. That delay, by the way, caused by a trespasser fatality near Newark Airport. So as of now,
That's
1
right,
hour.
Newark Airport.
Yeah, well, of course, everybody goes by Newark Airport for the most part, but you've got 1 hour delays up to 60 minutes.
Okay, Charlie Powell, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. The red headline crossing the Bloomberg terminal. The EU proposes a 100 billion euro Ukraine aid for 2028 through 2034. So we'll have more reporting on that. We'll stay on top of that. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Lisa Mateo, and we're joined by Bloomberg's Christina Kino. Christine, what do you have?
Well, Paul, we got to take a look at the banks today. Big day, so let's dig into it. I want to look at Goldman, ticker GS. So Charlie mentioned shares are down across the board for all these banks reporting today. Goldman shares down 0.2 of 1%. So pairing some of those earlier losses, but you would not expect that from a bank that just reported its best stock trading quarter in history, right? That's trading revenue of more than $4 billion, which is about $600 million more than what analysts are expecting. Fixed income revenue and investment banking fees also healthily exceeding analyst estimates. But I was asking the Markets Live strategist just before I came on here why the reaction, right? Very muted. And that is because Goldman shares seem to be essentially a victim of their own success. We did see those shares hit record highs earlier in July. A lot of expectations heading into the earnings season. And even though Goldman handily beat them, it really was a sense of price to perfection when it comes to the share price. So we're just seeing a little bit of a pullback there today.
Bank of America also lower this morning. They're down like 0.4%, but they posted this record second quarter. That's crazy.
That's right. That's right, Lisa. Yeah, so Bank of America ticker BAC shares also pulling back this morning. Interesting, though, because, you know, the equity trading revenue that was really the key to Goldman's success was a little bit softer, you know, in comparison for Bank of America. That did $2.1 billion. That's, you know, that's nothing to sniff at, and it did top expectations, but it is slightly softer from the previous quarter. But net interest income rising 7.1% to more than $14 billion. Also, CEO Brian Moynihan commenting on the state of consumers, saying that they are resilient, they have healthy spending, they have asset quality. So pretty upbeat assessment there of how households are doing.
And as Charlie Pellet just reported, we have the CEO, Mr. Moynihan, on Bloomberg Television with David Weston, 2:30 p.m. Wall Street time today. How about our good friends down in New Brunswick, New Jersey, Johnson & Johnson?
Yeah, Johnson & Johnson, ticker J&J. So that's a stock that's doing really well this morning. Shares up just over 4%. Earlier, they were up even higher, 6%. And that's for the biggest gain in 2 years. We did see their second quarter sales at $23.7 billion, beating expectations. Company also raising its full-year outlook. And so it's interesting because we did have President Trump speaking a week earlier saying that he would impose tariffs of as high high as 200% on drug companies if they don't start shifting their manufacturing toward the U.S. in the next 18 months. But then according to CFO Joe Wolk, that's actually good news because that means it's a slow ramp up to tariffs, and the 18-month runway is a recognition that it takes some time for companies to be able to do this, right? And so they're treating that as good news. Shareholders like it, and we're seeing its first gain in 3 sessions.
Very good. Christina Aquino, Managing Editor for Markets Live for Bloomberg News. And if you want more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Let's get the latest on the trade news, the tariff news. It is fluid to say the least. And we checked in with Brendan Murray. He's Global Trade Editor for Bloomberg News. Brendan, what's the latest here on this ever-changing situation? What are you paying attention to?
Well, the latest thing we got was this deal that the president announced with Indonesia, which Indonesia actually confirmed that it did happen. That was unlike the announcement Trump made about Vietnam, where Vietnam still hasn't confirmed there. So we basically have 2 deals in the bag out of many dozens. The UK, which signed theirs a month or 2 ago, and now we have Indonesia. There are also others in the works with India, with potentially Taiwan, with the European Union and Switzerland. So there are multiple balls in the air right now that the administration is juggling when it comes to trying to bring these talks over the finish line. There's a lot of complicated issues, and it could go right down to the August 1st deadline that the president has laid out. So one of the main things that we're looking for is how much the administration, how much flexibility there is in that reciprocal tariff rate. It's currently at a base of 10%. It's up as high as in the mid 40s for several countries. So Indonesia brought theirs down to 19% from a threatened 32%. So there's some wiggle room there. It just depends on what these countries are willing to offer and whether Trump is willing to accept those.
Now, Brendan, President Trump also said higher rates for pharmaceuticals could be coming sooner than later. So why the change? And is this going to be kind of a quick change, a slow progression?
Yeah. Well, these pharmaceutical tariffs and these sectoral tariffs in general play into these other bilateral negotiations. The European Union has a lot of pharmaceutical companies that export to the U.S. India as well would be threatened by pharmaceutical tariffs. So there are points of leverage that the president is imposing on these talks to try to drive things toward a deal. A lot of those countries are worried about the sectoral tariffs on pharmaceuticals. Something on semiconductors is also in the works. We've already got it on steel, aluminum, and cars, and copper was another one that's most recently. So all of these are the cards that President Trump is playing at the table, at these negotiating tables, and they will apply pressure just as much as the reciprocal tariffs will.
Brendan, August 1st is being held out by President Trump as a date where he wants deals done, or a lot of these tariffs are going to go into effect. What do we know about that August 1st date? How hard is that?
Well, the president would say, and he's, we've seen this strategy before, that it's immovable, that there's no flexibility in it. That's the date when this tariff is going to kick in. But of course, we went through July 9th, the previous deadline, and that was pushed back by 3 or 4 weeks. So you never really know. That's part of the strategy here is to keep the trading partner off balance, keep things uncertain, keep them kind of guessing as to whether he's serious this time or not. It seems to be baked into the strategy more broadly. The other deadline coming up in August is the end of the ceasefire in the U.S.-China tariff situation. And Treasury Secretary Bessent said on Bloomberg Television yesterday, actually, that there is some flexibility in that. So there seems to be some flexibility in it for China at the moment, but the president has indicated none of that yet for these other major U.S. trading partners.
And Brendan, before you go, you mentioned semiconductors. So does it go beyond chips, though? I mean, can this also hit products like Apple, Samsung, laptops, smartphones, things like that?
Yeah, potentially. One of the hallmarks of these 232, these sectoral tariff investigations, is it won't only hit the raw material or the specific item. It could be expanded to include products that include them. The Trump administration did this with the steel and aluminum tariffs. They threw in, washing machines and some products made with steel and aluminum. So they can be pretty broad, and they can hit a pretty wide range of products.
Brendan, thank you so much for your reporting once again. Brendan Murray, global trade editor for Bloomberg News. He's over there in our London offices, Queen Victoria Street. And again, the tariffs are a fluid situation. August 1st date is out there. It looks like negotiations are going on with many countries. The most recent one, we saw something from Indonesia, as Brendan was reporting. We'll stay on top of that. Mixed market here. The S&P 500 is pretty much unchanged on the day. 30-year Treasury, 4.98%.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:21 on Wall Street. We do check markets all day long here at Bloomberg. We got the S&P 500 index back in the green. This Bloomberg Business Flash is brought to you by Oracle. Attention growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure for new U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. Lots of earnings and a choppy start to the trading day. We're roughly 50 minutes in. We've got the S&P now up 562.49 after swinging between gains and losses, up by about 0.1%. The Dow up 76 now, higher by 0.2%. NASDAQ, though, remains swinging between gains and losses, up now by 1 point. Little change there. The key takeaway, the Russell 2000 index of small cap shares up by about 0.6%. 10-year 4.44%. The 2-year 3.92%. Gold up $2 the ounce, up by about 0.1%. And West Texas Intermediate crude down 1.1%, 65.81 for a barrel of WTI. Again, stocks now trading higher across the board with the Dow, the S&P, NASDAQ all in the green. NASDAQ just turning higher, up under 0.1%. Earnings news, J&J shares, they're up 4.7%. Johnson & Johnson beat Wall Street's quarterly sales expectations. It also raised its full-year outlook. J&J up now by 4.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right. Thank you, Charlie. This is Bloomberg Intelligence. I'm Lisa Mateo alongside Paul Sweeney. We do have some news out of Hewlett-Packard Enterprise. So it's creating this new strategy committee, turning to Elliott Investment Management for help with this. Here with all the details and to break it all down for us is Woo-Jin Hu, Bloomberg Intelligence Senior Technology Analyst. Woo-Jin, thank you for joining us. I want to start with, of course, who is involved in, who is part of this committee?
Yeah, sure. Thanks, Lisa. So it is a hand-picked board member by Elliott Management. Keep in mind, Elliott is an activist investor that has a 10% plus shareholding of HPE. I believe they made their position early in this year, and who they appointed was Bob Calderoni, who has done similar type of deals in terms of taking companies private, or more importantly, operational streamlining. So any changes, I think Elliott is going to try through Bob to affect a lot of changes at HPE.
Would you just remind us what HPE is today, number one, and number two, what do they need to fix to move this thing forward?
Yeah, hey Paul. So HPE is one of the leading enterprise IT infrastructure vendors. They provide servers, storage, now a bigger networking presence with the Juniper acquisition. And actually, quite frankly, there's quite a bit to fix. From an operational standpoint, they fumbled the first quarter results by mispricing their server business, and it seems to be reconciled now, but it flags some of the operational issues, number one. Number two, they have made a lot of M&A that just didn't create the synergies that they had hoped. So, they did hire the former HP CFO to streamline the financials, and with the Juniper merger starting underway, I suspect that the new strategy board it will try to find more operational synergies between the two networking businesses.
Woo-Jin, can you dig more into how it's under pressure, kind of like lagging behind Dell in growing AI? What kind of pressures are facing in that market?
Yeah, so if we think about AI, right? HPE actually owns Cray, and we think about high-performance compute. They are the market leaders there. They weren't able. HPE has not been able to transition that Cray business elegantly to the AI side of things. So let me put this into context. I think HPE should be on track for about $3 to $4 billion in AI sales this year, possibly 4 to 5, right? Dell is going to be on track for about $15 billion this year, and Supermicro is probably on track for about $20 billion this year. So they've lagged on the AI front, even though they have some of the leading technologies in high performance compute. That's an area that could be fixable. under the right hands.
One more here before we let you go, Wooj, is just, you mentioned they own Cray, they own Juniper. If I'm Elliott Management, am I thinking about maybe they could be selling or spinning off some of these businesses to enhance value?
Well, Bob Calderoni used to be on the Juniper board, and they actually helped with the operational streamlining of Juniper, right? So I think that you want to keep Juniper.
Okay.
Right? There are other aspects of the networking business that you could probably parse away, right? The Cray business you'd want to keep because AI is going to be the growth engine and also help you transition to the enterprise AI.
All right. Woo Jin Ho, thank you so much for joining us. Woo Jin Ho is Senior Tech Analyst for Bloomberg Intelligence, based down there at our BI offices down there in Princeton, New Jersey. Let's get back to the economic data. We had CPI yesterday, PPI today. I don't know. I'm not seeing a whole lot of inflation out there. But let's talk to somebody who actually gets paid to look at this stuff for real. Our good friend, Yelena Shuletieva, economist at the Conference Board. Yelena, thanks for being in our studio. Appreciate it. It's great to see you again, longtime Bloomberger. We're not seeing inflation to really any meaningful level here. Does that surprise you at all?
Well, probably, Paul, because you're buying a lot of services and not goods.
Okay.
So it's really a story of two tales here. So you do see a pass-through of tariffs into the goods inflation. So it was evident in the data yesterday in the CPI report. It was already evident in the PPI data this morning, so you do see a pickup in goods prices. But that comes at the expense of lower demand for services. So, and that is pushing, that is keeping prices for services in check. So what matters for the Fed, obviously, is the overall growth in inflation. Probably we haven't seen the full extent of it. That is why it's so important to watch what happens to the data over the summer months. But I think that it would be premature for them to cut rates at this month's meeting and going into September. I think December is probably the best case.
You mentioned it. Okay, I was going to ask if you adjusted your Fed cut rate, so you answered my question there.
Not on this data.
Okay.
But overall, the data was coming in a bit better than expected for consumers, for the labor market, and that kind of resilience led us to revise our GDP projections a little bit so that the trough in economic activity happens towards the end of the year, in the fourth quarter, and not in the third quarter that we previously expected. So also the pass-through of tariffs seems to be happening at a little bit of a slower pace. Companies stocked up on cheaper inventories earlier, and they are releasing it into the economy right now. So, but we are going to see this higher prices in the summer months and going into the second half of the year, and that would weigh on consumer spending in the second half of the year as well.
So the consumer right now, as you mentioned, seems pretty solid. How solid do you think they're going to be when maybe inflation does become a little bit more prevalent?
So consumers, it's a very difficult question. So on one hand, you do see the overall pace of spending remaining at a solid level. It's all kind of a happy consumer kind of thing. And obviously, if you look at the quarterly results from the banks, it's also telling you that consumers are in a good spot. But you do see some weaknesses, and it's not only about the increase in goods prices. You also have to factor in what happens to student loans, the availability to get a student loan, credit scores, things like that, that all, together would limit the extent to which consumer spending could grow, especially going into the Christmas season and early next year.
Yeah, so consumer spending, we have retail sales coming up this week too. Do you think it's going to disappoint? What's your take?
I think it's going to disappoint. And even if it's a positive surprise for any reason, I would look into real retail sales. It's not a perfect measure, but you at least have to discount it by CPI data that is available. Because remember, retail sales are reported in nominal dollars. So if it's a positive number, is it an increase in inflation or is it an increase in real spending? Also, I will be looking at goods versus services. Unfortunately, there's only one category that goes into retail sales report in terms of services. It's restaurant spending. So is it weak? Is it strong? That will tell us a little bit more about whether consumers are spending on discretionary items, such as going out, for example. That would tell us a little bit about the state of the consumer going forward.
Red headline crossing the Bloomberg terminal, and I always love these. Citigroup poaches 2 senior JP Morgan bankers in a hiring push. Right as these companies reporting earnings, we'll have more reporting on that. Elena, the labor market still seems like if everybody wants a job, they can get a job. Are there cracks there, or does it still look pretty solid?
Still solid. I agree with that. And going forward, maybe we will not see a significant increase in the unemployment rate. Here as well, it's a story of two tales. So it's about the demand for labor and it's about the supply of labor. Both are kind of weakening. That is evident in the data that we see. So which one weakens quicker is going to define what happens to the unemployment rate, the metric that the FOMC watches. So it's not only about immigration, right? Immigration, we know the inflows are slowing, and that is putting a weight on the supply of labor. It's also aging of the population. The structural change that has always been there, despite, presidential elections, despite all the things that are happening in the monetary policy, the structural change, the supply of labor is shrinking because we are getting older. So that is putting a downward pressure on the unemployment rate. And at the end of the day, that the unemployment rate is what matters for the Fed and for them to conduct monetary policy.
In the last kind of 30 seconds we have less, let's talk about the pressure surrounding Fed Chair Jay Powell to step down. The question for you is, should the markets kind of be pricing in any pressure on this?
Well, my opinion probably won't matter. The markets will vote on, the next Fed chair before the Senate does. But the Senate will need to approve the nomination. So that's one thing that I would note. And another thing is that if you think about the meetings next year, there will be 5 meetings without Chair Powell if he actually finishes his term in early next year. So could be a lot of dissents next year, and that's not positive for the markets.
All right, Elena, thank you so much for joining us. Always appreciate getting some of Elena's commentary. Elena Shilatieva, economist for the Conference Board, joining us live here in our Bloomberg Interactive broker studio. Coming up, we're going to check in and get some more on the news coming out of some of these banks. Allison Williams, Bloomberg Intelligence. She covers all the big banks. She's been busy the past couple of days, and we'll get her wrap-up of what we've seen out of seemingly some really good numbers out of some of the big banks. They're doing very well, it seems. Looking at the market here, kind of mixed, not a whole lot, a little bit of green on the screen here. We've got the S&P up about 5 points, the Dow up 60 points, the NASDAQ up 9 points. We're going to have more coming up. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. Little change for the U.S. equity market with the Dow higher, S&P, NASDAQ, little change. Key takeaway there, we've got the S&P 500 index, which sums it all up right now, down 0.01%. A rout in chip makers weighing on stocks, briefly wiping out gains, fueled by a softer than estimated inflation reading that reinforced the case for the Fed to cut rates this year. S&P right now swinging between gains and losses. We're up a point. The Dow up 20, up less than 0.1%. NASDAQ Composite Index higher by 3, also little changed. The 10-year at 4.43%. We do have the 2-year currently yielding 3.91%. The 30-year 4.96%. Gold flat on the day, $33.23 the ounce, and West Texas Intermediate crude down 1.3%. Right now, WTI $65.64 a barrel. As for overall market valuations, Philip Newhart is Director of Market and Economic Research at First Citizens Bank and Trust. He was interviewed this morning on Bloomberg Surveillance.
I think you could argue the largest names are expensive for good reason. Really high gross margins. Look historically, the market does pay up for margins. That said, when you move outside the mega caps, valuation is not that expensive versus their own history. We're overweight small cap, for example. We do think that there is potential for return outside those largest names that are not all that expensive versus their own history.
Philip Newhart of First Citizens Bank. He mentioned small caps. We do have the Russell 2000 index pushing higher up by about 0.4%. HPE, a company we were just talking about, has announced several business changes, including the formation of a new strategy committee. Shares little change right now. HPE down under 0.1%. The big story, though, ASML Holding, its CEO walking back the company's sales forecast for next year, blaming trade disputes and global tensions. ASML down now by 11%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We are streaming live on YouTube as well, so go check us out there. I've been doing the stock market thing, Lisa, for like 40 years almost. Still have no idea how this whole thing works. I mean, looking at Goldman Sachs, Morgan Stanley, B of A, they had what I thought were really pretty darn good quarters in a world where we're not really sure what's going on. So, of course, all the stocks are trading down today, so I can't figure it out. But our next guest is an expert. She knows what's going on. Allison Williams, senior analyst. She covers all the big banks and all that kind of good stuff for Bloomberg Intelligence. She joins us here in our studio here. So, how are the big banks, investment banks, doing this quarter?
Well, you mentioned you've been doing this 40 years, and you've never seen a quarter like you saw at Goldman Sachs. Equity trading, record trading. I mean, the really standout for Goldman is they're the biggest in equity trading. They are the biggest in M&A, and they had the biggest jump, so really solidifying that leadership. I mean, the equity trading up 36%, prime brokerage, cash, derivatives. We talked about the fact that we saw record trading on the equities exchanges this quarter. We certainly saw that come through at the banks. M&A, Goldman talking about the fact that announced volumes are up 30% and we're running above average now, so that bodes well for the future. And I think, in terms of the stock reactions that you referred to, I think, so as I said, we can see that there was a lot of strength in the exchange volumes. We could see that, IPOs had rebounded the last couple of months, even though, it wasn't in analyst numbers. I think there was some visibility there. So I think in terms of what the stocks are reacting to, Morgan Stanley had a really strong quarter, beat everything, but just not as good as Goldman. And I think people are looking at that equities trading. Morgan Stanley was in the lead for a few years, and now Goldman is really pulling ahead.
Yeah, and I see, because the whole morning I was like, why is the stock lower ever since the bell opened?
It is, and by the way, like wealth is the business that people watch for them. The wealth flows, the numbers were good. So again, what are people worried about? So it could be the market share. Morgan Stanley did point out that they had a record quarter in Europe. They say that they're gaining share. We'll see what happens when the Europeans report. And Asia, the other thing is capital. So buybacks Better than expected at Goldman, weaker at Morgan Stanley. And keep in mind, we've seen these big moves in the financials. A lot of that is really about the capital return story.
Well, and the consumer resilience, we look to Bank of America for that. So did you see it?
We did see it, and I think that is what we saw in the quarter. So net interest income, as well as charge-offs. Those are kind of the two bank business lines, if you will, that are most revolving around lending and consumer health. And interest income, it was like a little bit soft in the quarter, but the outlooks are fine or better. And credit coming in line to better than expected. And the reserve building really telling you that, look, there is some conservatism baked in for some uncertainty in the second half. But in general, things are improved.
When President Trump was elected for this second term, almost immediately people were saying, buy the banks. They're going to be the beneficiaries of reduced regulation and reduced oversight. Has that happened? Do we still expect that to happen? Is that still part of the story?
I think we're on a journey, I guess, if you'd say, isn't that the current rhetoric? But I think that's why the buybacks were important, right? So one of the things that people are very excited about in terms of reduced regulation is holding less capital. Returns on equity are going to go up mathematically. There'll be more money to return to shareholders. I mean, Goldman had really that leading dividend increase that we saw after the stress tests. Buybacks better than expected. And meanwhile, we saw the weakness at Morgan Stanley. Wells Fargo, another one. That was another bank that investors were really optimistic about after the U.S. election. They did get the asset cap removed, so I think there's a long-term overhang over the stock. But in the current quarter, people were a little disappointed. They didn't give any guidance on buybacks. They didn't change their return target, and it just might be that's going to come, but didn't get the news yesterday.
Private credit. Where do banks stand with private credit? You had J.P. Morgan say they would invest like $50 billion in private credit. So what kind of example does that set for the industry?
I think, and Jamie Dimon also, I think, made some comments around private credit that I know were picked up in the headlines. I think that, again, private credit, it's been sort of, the hot item for us all to talk about. But, maybe, and we are seeing, continued strength. I think we do expect continued fundraising. But, I would say nothing really stands out this quarter from any of the banks.
Yeah. Elise was asking before we went on the air, can she ask you about private credit? And I said, you can ask Allison about anything, and she'll have an informed opinion. That's why I'm going down this alley. Strong results out of the U.S. big banks this week. We're going to hear from the European ones, I guess, next week. When is the European Union going to say, if we ever want to compete in global finance, we have to allow merger deals? Is that even on the table?
I mean, I think that it does come up, and I think we have heard regulators talk about it, like, yes, we should do something. But the question is, everyone wants to be the one, the victor. They want to be the one, where their champion is the buyer. And so I think that's where the rubber meets the road, if you will. It will be interesting, to your point, when we see those Europeans report. Again, Morgan Stanley, record quarter in Europe. They said the first half, they called it extraordinary in Asia. Obviously, we know Asia is a lot of diverse parts, but the Europeans, like UBS, have tended to be stronger there. So if this quarter we don't see them participate and kind of follow that Morgan Stanley lead, that will give us further proof that they're actually losing share in their home market, and that should be a little bit more concerning.
I mean, you could argue that the horse is already out of the barn. They've missed it. I'm just thinking 20 years ago, it was so much more competitive. They were so much more competitive. I remember just going up against some of those big European banks, and now it's almost like an afterthought. It's just amazing how that's evolved. Allison Williams, thank you so much. Appreciate that. Allison Williams, she's a senior analyst, covers all global financials. If you have any question on anything on global Wall Street, you can just go up to Allison on the street and ask her. She'll have an answer for you. She's with Bloomberg Intelligence, a founding member of Bloomberg Intelligence, I might add. S&P 500, it's up 5, Dow's up 90, NASDAQ's up 9. Tom from the Upper East Side asking for a Bitcoin quote, $119,000. Where was I on? This is Bloomberg. Good morning.
listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, welcome back to Bloomberg Intelligence. I'm Lisa Mateo alongside Paul Sweeney. Where does the housing market stand, right? Housing starts building permits later this week. Let's go to someone with insight on all this and all things housing. It's Mickey Naftali, CEO, founder of Naftali Group. Thank you for joining us, Mickey. I want to start there because Naftali Group actually has market housing insights from New York to Florida. So I want to start there and say, how do you kind of see the migration? Is that trend still happening? Are people still leaving the city, going to Florida? Is Florida still the hot spot?
I think both are really doing very well, New York and South Florida, and especially Miami. You know, I try to explain people, this is not a competition. I mean, Miami matured to a point. It's a real brand. You know, we all as people, we have different things that we like, and some people prefer to live in South Florida or in Miami, a portion of Miami of South Florida, and many people love New York City. I can tell you that we have billions of dollars now in New York in different projects between for sale condominium and rental, Class A rental, and we're doing very well. Everything is moving very well. Different neighborhoods, so kind of different demographic. We're not focusing on only one specific neighborhood. And the same with South Florida. We have a very big project in Miami. We're doing well there. We have a very big project in Fort Lauderdale. Of course, the summertime is a little bit slower there, but that's just a typical thing. But overall, some people are moving from New York to Miami. A lot of people are moving to New York. You know, the occupancy rates are close to 100% in New York. So it's really not a competition here.
Talk to us about the various boroughs in New York City, Mickey. Where do you guys like to invest your capital?
So we really follow the demand, right? I mean, you know, we think that we are quite good in what we do, but we are not good enough to create a demand. So you really need to focus on the demand. I can tell you as we speak right now, we have the Henry on the Upper West Side, which is doing very, very well. It's for sale, almost sold out. We have a 50-story on the Upper East Side on 77 and 2nd, doing very well, for sale condominium. Both of them designed by Robert Stern, which is a great architect. We have a project in Gramercy Park area that is doing very well. And we have a project in Williamsburg Wharf on the East River. Completely different demographic, right? Completely different neighborhoods. All those 4 projects with thousands of units are doing very well. So, you know, to me, at least the way we see it through our projects, you know, the market is strong. There is not a lot of inventory. The capital market is tight. I would say that only the top tier of developers can really get financing, or at least financing in reasonable rates. And so there is not much inventory, and there is a strong demand.
Since we're talking about New York, I have to bring in Democratic nominee Zohar Mamdani. He talked about plans for housing, right? Freezing rents on rent-stabilized apartments. What would something like this, what would that do to the housing market in New York City?
I mean, look, we are not really investing in rent-stabilized type of buildings, but when we build, for example, in Williamsburg Wharf right now, we are building 535 Class A rental units, and you know, still in what I call the old Affordable New York program. So that is fine. That's new construction. But I can tell you that if that will be the case, I'm not going to for the near future. I'm not going to build more a rental building. So how exactly it's helping anyone, I'm not really sure. I mean, at the end of the day, whoever is building it, whoever is operating those buildings, those are very costly. So no one is investing in environment when you look at the investment and you think you're going to lose money. No one is going to do it. The government cannot do it. The state cannot do it. The city cannot do it. Let's be real about all of that. So, at the end of the day, if it doesn't make financial sense, no one is going to build those rental buildings. So how exactly we're solving the problem?
Mickey, thanks so much for joining us. Really appreciate it. Mickey Naftali, CEO and founder of Naftali Group, joining us from NYC via that Zoom thing. And I'm just looking through the notes, Lisa, and they got developments, Brooklyn, Williamsburg, and he says, you mentioned Upper West, Upper East. So they're kind of focusing on kind of Brooklyn and Manhattan. And it just seems like there's always demand for rental properties in the city. I'd never...
But can you afford it?
Exactly. That's the thing. I mean, there was a blip during the beginning, and I'm going to measure this in just a few months, the beginning of the pandemic, where people scattered, and it did crater. And my daughter was actually in the market at that time, and she did get like these huge concessions. They, got 6 months free and the blah, 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 the cutting thing. That lasted literally 6 months, and that was it. So
but she's still in Brooklyn. So.
She's still in Brooklyn, so there you go. All right, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Oracle. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just a moment. We're looking at this market. We got the S&P down 3 points. The S&P down 3 points. The Dow Jones Industrial was up 22. NASDAQ down 23, so no real direction there. The story's been on the yield curve today. Now we're seeing movement there. The 10-year Treasury off about 3 basis points, 4.45%. We did have higher rates earlier. This is Bloomberg.
This is Bloomberg Intelligence with Paul Sweeney.
The real outperformance has been the U.S. corporate high yield. These are two big-time blue-chip companies. One person's chaos is another person's animal spirits.
Breaking market headlines and corporate news from across the globe.
Our view is that the economy is slowing down.
There is the possibility of a death spiral.
Both quantum computing and AI are going to power the future.
People are just buying everything with tech.
Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, coming up in this hour, let's talk some booze, shall we? Duncan Fox, Bloomberg Intelligence Senior Consumer Staples Analyst. He's going to talk about Diageo, the big spirits brewer and manufacturer and all the kind of stuff, distiller. Their CEO stepped down. What's going on over there? Herman Chan, Bloomberg Intelligence Senior Analyst for the regional banks here in the U.S. He's going to preview some earnings. We heard from the big money center banks. Now it's time for all the regional banks from around the country to report. We'll get a preview there. So we'll have that as well. We're also going to talk to Jim Walden. He's a New York City mayoral candidate. He's for the New York City. He's in our studio coming up at the bottom of the hour. So we got a lot coming up this hour. Let's kick it all off with Charlie Pellet.
I thank you very much, Paul Sweeney. The Dow higher, S&P higher. For now, NASDAQ in the red. Rout and chip makers weighing on stocks, which halted gains fueled by a softer than estimated inflation reading that reinforced the case for Federal Reserve rate cuts this year. S&P right now swinging between gains and losses. Let's just call it unchanged on the day. We've got the Dow up 15 right now, up by less than 0.1%, with the NASDAQ Composite Index falling 10, drop there of under 0.1%. Bottom line for the equity markets, little movement this morning. We've got the 10-year yielding 4.45% with a 2-year 3.90% and the 30-year 5.00%. Spot gold up $15 the ounce, up 0.5, 33.40 on the precious metal. West Texas Intermediate crude down 1.1%, 65.77 a barrel on WTI. Bitcoin back at 119,000 and change, up now by 2.4%. So the Dow, the S&P in the green, NASDAQ in the red right now, and the Federal Reserve and rate cuts certainly on everybody's mind. Amanda Lynham is head of macro credit research at BlackRock. She was a guest this morning on surveillance.
We were never expecting a cut in July, and I thought even September was difficult. The market seems to be further pricing out the next Fed rate cut, and I think that's probably appropriate.
BlackRock's Amanda Lynham interviewed this morning on surveillance. You can hear more of that conversation on the Surveillance podcast. podcasts. Banks front and center. Goldman Sachs, Morgan Stanley, Bank of America. They're all trading lower right now. Goldman Sachs down 0.7%. Morgan Stanley down 3.4%. Bank of America down 1.7%. By the way, 2:30 p.m. Wall Street time. Our David Weston will be talking with Brian Moynihan, the CEO of Bank of America. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, thank you, Charlie. All right, it's time to take a look at some of the stocks on the move. I'm Lisa Mateo with Paul Sweeney. We're joined by Bloomberg's Nora Melinda. Johnson & Johnson came out with earnings today. How'd they do?
Right. I mean, we've been talking so much about banks today. I wanted to talk about this pharmaceutical space. As you mentioned, Johnson & Johnson. J&J is the ticker there. We're seeing shares seeing their best day since 2023 and hitting their highest intraday level since March. So a really good day today for Johnson & Johnson. This is after it beat Wall Street's quarterly sales expectations and raised its full-year outlook. And of course, this is kind of showing confidence about the pharmaceutical industry more broadly, which we know has been in the spotlight as of late, especially with Trump telling reporters that he would impose tariffs as high as 200% on drug companies if they don't shift more of their manufacturing to the U.S. So, of course, we're seeing the street kind of rallying behind this stock. It's the biggest gainer right now in the S&P 500 by a percentage basis.
Which, as you mentioned, I think that headwind from President Trump's tariff discussion as a risk, boy, that's a huge headwind, I would think,
absolutely,
for these stocks. But hopefully it's be a little bit less severe when push comes to shove there. But still, as you mentioned, a good day for New Brunswick, New Jersey-based J&J Prologis.
Prologis. So this is one of the companies I cover, ticker PLD. Yes, it's an industrial REIT.
Cool.
It's actually a bellwether.
Real
estate. I know. Always got to bring it back to real estate here. Well, it's a bellwether for the industrial real estate space, but it is seeing its best day since May and hitting its highest intraday level since March, after its better than feared second quarter earnings. So essentially what happened here is that it raised the midpoint of its core FFO guidance, which stands for funds for operations, which is the main metric that a lot of people like to follow. You said a scam.
First time I heard that was 1993. A REIT analyst came in and made a pitch. And he's given FFO estimates.
And you said, what is this?
I thought my EBITDA was cheesy, but FFO was taking it another
Well,
step.
that's what they love. They love it here. Evercore is saying that the results were better than feared, and essentially they see the increase as a surprise to them. And so we're seeing the stock, of course, benefiting from this. It's one of the top 3 gainers in the S&P 500, actually, on a percentage basis. Stock is up about 6% year to date, though.
Oh, there you go, blue button. Last one, Global Payments.
Global Payments, that's ticker GPN. I'm looking at this company. It's an electronic transaction processing company, but it's hitting its biggest gain since April right now. And this is after a Financial Times report that activist hedge fund Elliott Management has built a sizable stake in the company. We're seeing it as a second biggest gainer in the S&P 500 this morning, while Global Payments didn't initially respond to requests for comments, and Elliott also declining to comment. Of course, we're hearing a lot of speculation on the street about what this could mean for the company more broadly. We're seeing volume on the stock jumping almost 7 times its average. So stock is down 28% year to date, but this is a good day for them today.
Very good. We appreciate that. Nora Melinda, Bloomberg Equities reporter. For more conversations like this, subscribe to our new Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. All right, Lisa, according to CBS News, this is a CBS News report, President Trump asked GOP lawmakers if he should fire Fed Chairman Jay Powell, sources are telling CBS News. So advancing that storyline, I guess. But that is an issue, and there's a question about whether he can do that, and then there's also a question of would it really be who would replace him? And then what? Because you have a committee here setting interest rates, not just one person here. All right, let's get back to a story that crossing the tape over in Europe earlier this morning. Diageo CEO Deborah Crew steps down. What's going on there? Duncan Fox, Bloomberg Intelligence Senior Consumer Staples Analyst, joins us here. Duncan, what's happening at Diageo?
Well, I suppose the performance of the shares and the organic growth and sales, etc., haven't been very good for the last couple of years since she became CEO. So there was sort of rumours, bit of pressure that she should go, but it's ironic that she has outperformed the other spirit companies in Europe over that time period. So I think it just shows you have to show something to shareholders, not to sort of have rumblings of discontent in the background.
So how long has she been there, and then who's stepping in for now?
Well, at the moment, well, she's been there 2 years as CEO, and she was sort of going to take over from the previous CEO, and she'd been there about 6 to 9 months before that to sort of get to know the business. Temporary CEO is going to be Nick Chingiangi, who's the CFO. He's only been there 9 months, so it's quite clear they now have to go out and get the right CEO to take them to the next phase, which essentially is getting through tariffs. And now that they've got rid of the excess inventory in most of the countries around the world, actually driving organic growth again.
All right, looking at the stock over the last 5 years on a compounded annual basis, Diageo down 5% per year. And when you put that against the FTSE, up almost 11% a year, you see the real underperformance there. But if you just look at it relative to the FTSE All-Share Beverages Index, that's down more than 2%. So it's not that bad relative to the industry, but it's a tough industry. Duncan, are there growth drivers for the spirits business?
Long term, yes. I mean, in the short term, you had obviously the excesses after COVID, where shutdowns of clubs and bars really hurt. So they had a nice benefit when everybody restocked. But then interest rates went up, inflation, that really killed people going out. And that's really the problems they've had to get over. And subsequently, you had tariffs in China, 39% of cognac, not actually affecting Diageo, but also President Trump, which I heard you talking about just earlier. I could not tell you what European tariffs will be. We know the UK will be 10%, so it's good for Scotch. But I have no idea what it's going to be for anything else that they've got within their portfolio. So, this is the problem. It's very difficult to pin down your earnings estimates. And they've obviously been falling for about 18 months, 2 years now, to really say that the recovery is coming, because we just don't know whether it's going to be 200%, which was rumoured at some point after April, or it could go down to 10. It really is up in the air at the moment, and that's the problem for the whole spirits industry, I'm afraid.
Yeah. Now, Duncan, you mentioned tariffs, but also there's a lot of stories we've been talking about people drinking less. I mean, does that play into this as well? Please. Except for Paul.
Well done, Paul. We need you to drink a lot more, by the way. There's a couple of issues there. I mean, it's true that the Gen Zs have, at some point, were sort of abstaining a little bit from alcohol, and I think people took that a little bit too fast, assuming that people were going to switch to cannabis-based beverages or something else. But what is happening is, what's happened for the last 20 years is that people are drinking less, but they're drinking better. So that actually plays into the spirits portfolio better than probably beer, to be honest, because you'll probably have an expensive cocktail whilst you're out with friends rather than 4 or 5 beers. So it's the way they've set the strategy up. Every company I follow has that as their strategy. They push you towards the premium brands. But to do that, you need inflation to be tamed. And that is still not a guarantee, just as we sit here today, as we saw from US and UK inflation today, US yesterday and UK today. So, there's still question marks over when the volume and the mixed sales growth will return in the spirits industry.
Well, we'll pay close attention to that. I can guarantee you that. Duncan Fox, Senior Consumer Staples Analyst for Bloomberg Intelligence, just breaking down what we're seeing in the global spirits business. Had some turnover, senior management at Diageo, and just kind of getting the lowdown on that side of the consumer right now. Let's go to the commercial banks. We've been talking to Allison Williams of Bloomberg Intelligence the past couple of days on the big money center banks, the big global investment banks. Now it's time to focus on the regional banks. And what I learned during a regional bank crisis a few years ago is the United States has about 5,000 regional and community banks around the country. I had no idea it was that many. I don't think Herman Chan follows all of them, but he follows a lot of them. Herman Chan, Bloomberg Intelligence Senior Analyst, he covers the U.S. regional banks. What are you expecting to hear from your banks this quarter? How is their business?
Right. So earnings season's kicked off today for a number of regionals. And what we've seen is just a resilient economy. Credit quality was really stable. A lot of the banks reduced their bad debt provisioning, so provisioning for credit losses. And that just shows that you're not seeing charge-offs really rise from here. Consumers are active in spending, and commercial borrowers are really transacting. They're preparing for tariffs, and you've seen an increase in lending activity because of that.
Now, when we look at local banks, I look at my local bank, and sometimes it seems like more of a billboard. I don't see it as so busy. I mean, talk about the trend of how these local branches are changing. I mean, some are cafes even.
Right, yeah. Banks view their branches as a marketing ploy and really to help support their customers. One thing that they're doing is they're reducing the real estate footage within these branches, so that's helping reduce costs. But a lot of the regionals that I cover are really expanding as well. They're growing in new markets, particularly where the growth is, right? So I cover a number of Midwest banks like PNC and Huntington, and they're growing in the higher growth areas, in the Sun Belt areas. So that's something that we see ongoing and just changing the mix of the demographic growth for that companies.
How did the regional banks compete with private credit? A lot of the private credit funds that we talk to, at least at the beginning, they started out targeting the mid-market, middle-sized market companies, not like the big multi-gajillion dollar deals. But that's right where those regional banks like to play. How's that dynamic, competitive dynamic working out?
Yeah, it's been interesting. I would say that for a lot of the regionals, there's not a lot of direct competition quite yet. I would say the private credit folks are catering to a more riskier company. So, for example, we've taken a look at this a little bit, where the private credit companies are, you're talking about loan yields north of 10%, whereas the traditional middle market bank borrower is much more stable. So we're talking about 6-8% yield. So it's a different company, but we do see private credit really will continue to encroach over time.
So you talked about some of the risks, some of the challenge that regional banks are facing. What are some of the things that they can kind of look forward to?
Yeah, really what a lot of the regional banks have talked about thus far in the second quarter earnings is there's some pent-up demand in lending, and that's been positive. Their customers are preparing for tariffs and really increasing their line utilization, which is helping commercial and industrial lending. And they've been really sanguine about the risk of tariffs, and we haven't seen really the credit quality deterioration that folks may have anticipated in April after Liberation Day.
Credit quality, specifically commercial real estate, there was concern that if there was going to be a problem in our financial system from some falling, particularly office real estate, that we'd see it in the middle-sized regional banks. Have we seen that?
Yeah, I would say that's an ongoing issue. We've seen losses continue, but they're manageable. Office commercial real estate on average for the companies that I cover in the large regional bank space is about 2% of their total loan portfolio. So it's manageable. PNC just talked about this earlier, just a few moments ago on their earnings call, and they said that charge-offs could rise in future quarters because of deterioration in commercial real estate, but they're already fully reserved for that, and they prepared for that eventuality.
Now, I cover a lot of different conferences here at Bloomberg, and one of them is with banks and AI. So how do regional banks, because they're not as big as the big banks, so where do they stand as far as AI and how much money they put into it?
Yeah, I view AI as a tool for the regional banks to continue to reduce their expenses. So it should help them in ways like reducing the employees in the cost center is one where regional banks use chatbots and AI-powered chatbots to really help their customer base with in a more efficient manner and things that are more human intensive. It could help reduce some of and streamline operations. Right now, it's more feeling it out. I don't think a lot of the regional banks have really jumped full board, but they are exploring ways to reduce costs over time.
All right, Herman Chan, thank you so much. We appreciate that. Herman Chan, Senior Analyst for U.S. Regional Banks for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. All right, here we go with another headline crossing the Bloomberg terminal, the red headline. Trump likely to fire Powell soon, White House official says. So there you go. And just like that, Bloomberg has a great article out there that was published just moments ago talking about Trump versus Powell. How far can he push the Fed chair? Trump has discussed removing Powell, but legal scholars say a president likely can't dismiss a Fed chair easily, as Section 10 of the Federal Reserve Act requires cause for removal. We'll have more on this. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Powell, headlines out of Washington. Stocks turn lower. Market moving story. And this Bloomberg Business Flash brought to you by Oracle. Attention, growing businesses. Oracle's offering to cut your current cloud bill in half if you move to Oracle Cloud Infrastructure. For new U.S. U.S. customers with minimum financial commitment. See if your company qualifies at oracle.com/Bloomberg. A White House official says President Trump is likely to fire Fed Chair Jay Powell soon, also discussing the possible move in a meeting with congressional Republicans last night. While the lawmakers voiced support for the move, which would likely roil financial markets and lead a consequential legal slowdown, Trump has not made a final decision and could change his mind, according to the official who asked to remain anonymous. Right now, swift market reaction. S&P down 25, 62.18, drop there of 0.4%. Dow also down 0.4%, and Nasdaq lower now by 96, drop there of 0.5%. Your 10-year 4.47%, with the 2-year 3.88%. Again, repeating our top story: President Trump likely to fire Fed Chair Jay Powell soon. This, according to a White House official. Keep it locked in to Bloomberg Radio for the latest developments out of Washington. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much for that reporting. Lisa Mateo, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. We're having a mayor's race here in New York City, and Jim Walden joins us here. He's a mayoral candidate. He joins us here in our Bloomberg Interactive Broker Studio. Jim, thanks so much for joining us here. Polling has you at 1%. Why are you still in the race?
That's not a good question. I just started my race, so anytime a new candidate without name recognition starts, 1% is a start. So it's all up from here. I'm not going to be daunted by one poll. It's interesting because in the primary, when there was the only independent poll had me at 6% against Mamdani and 7% against Cuomo. So listen, I've got a long road, but it's an exciting road ahead of me. I've got to meet every single New Yorker. We just started a citywide tour with a goal of visiting every single neighborhood in New York City by the time of the election. So we've got a lot of energy, and we're looking forward to it.
Now, it's a crowded space, too. I mean, there's 3 independent candidates running. You have Mayor Eric Adams, former Governor Andrew Cuomo, Democratic nominee Zohran Mamdani. You've been very critical of him. So what is your reasoning for saying, you know what, he should not be mayor?
Yeah. So to be clear, I've been critical of all of them. Sure. I've just been doing that recently with respect to Mamdani because the Democratic candidates just did such a terrible job with opposition research on him. And I wish that everyone had done a better job. But what is clear now is, and we have to believe his words, right? He's supported actual terrorists. His policies that he's going to use as mayor are anti-Semitic, without any question. He has expressed extreme police bigotry, calling them wicked and corrupt and saying that he wanted to dismantle them. And the policies that he has, although he's trying to frame them as a centrist, he's really putting lipstick on a pig. He does intend to defund the police. He's basically said, I'm going to keep current staffing levels, even though every reasonable adult policing expert has said we're at least 4,000 police officers down. So that's effectively defunding the police. And he's going to attack every single business that has a commercial relationship with Israel or Israeli companies. So those things are clear. So at this point, I view Mamdani as an existential threat to the city. He's been anti-business, anti-real estate. He hates the wealthy, and that is not going to help strengthen our safety net.
Given all those points, why do you think the Democratic Party favored him in the primary decisively?
So they did, and he did a great job campaigning. I take nothing away from him when it comes to his gifts as a retail politician. But I think that people wanted to be inspired. I think that there are a significant number of his supporters that will be his supporters no matter what comes out. In that way, Zohran Mamdani is a lot like Donald Trump. Donald Trump famously says, I could shoot someone on the street and I'd still be the president. And Zohran Mamdani has that sort of hold over many of his people. But there are people that have buyer's remorse because they didn't realize how clear he was about his underlying values of expressing support for terrorists and being anti-Semitic and being anti-police. And those are the people that I'm trying to speak to bring them over to the adult side of the equation, where I have policies that are clear, detailed, and achievable.
Now, you mentioned the president. How would you work with President Trump if you were elected?
I don't think that the mayor of New York City should declare open warfare on the president of the United States or a stump to be the one that Trump hates the worst or hates the most. I want to have a collaborative relationship with Washington, with both Congress and with the White House. Now, I have had historic disagreements with the president. I sued his campaign. I was the one that asked a judge to release the transcripts during the Bragg trial. I was the first person to articulate a RICO theory on TV after January 6th. I'm not the president's favorite person, but I'm pro-business and pro-real estate. And there's an area where Donald Trump and I will find a lot of agreement because we need more businesses to grow our tax base. If we want to increase the strength and size of our safety net, we need more businesses if we want really good paying jobs with benefits, and we want to solve the affordability crisis. We can do that in partnership with business, not at war with them.
One of the key issues for all candidates, I'm sure, is crime and safety in this city, homelessness in this city. Can you wrap that all together and give us a sense of how you might address that in your administration?
Yeah, of course, a couple things. One, definitely I would get more police officers on the street. We could hire 9,000 police officers at higher starting salaries with 56% of the overtime budget. But we have to do something now. And there are two things that we can do immediately to get cops on the street. We can increase the retirement age so that there's thousands of cops that would like to keep working, but they're aged out. That's number one. Number two, we could grant more waivers so that they could live outside of the city, which many police officers want to do. And number three, we could get people out of administrative jobs that have guns. And from that alone, we might be able to add as many as 2,500 police officers without any other changes. But we have to get mentally ill people off the street. This is personal to me. My sister was mentally ill her entire life. She died as a result of it. And I know that the streets and subways are not a safe place for mentally ill people, and I am determined to get them into long-term treatment. There are many different ways to get it done, and I'm going to get it done because it's important for them. It's important that we show our humanity to them, but it's also important for our safety that we take them out of situations that they're creating crime and disorder that's not their fault.
Now we go from that to the housing crisis in New York City. What's your solution for that?
Oh, I've got a 100-page plan on this. Build, build, build.
Do tell.
No, listen, there's so many different tools that we have to solve the housing crisis. And I put out a blueprint for the city that has a very ambitious goal. It's to solve the housing crisis. What we see from other people is Band-Aids on bullet wounds. And we see plans that have no detail behind them. I worked on this hard because I know development, and if we give developers the right incentives, we can actually build a rent stabilization system that's actually better than the one we have now, where people are capped at 25% of their actual income rather than the way that we're doing it. So rather than freezing the rents, we can lower the rents. And I have an interim plan to lower the rents for the severely rent-burdened people even when I start my administration. So we're very excited about our housing plan.
Who's going to pay for this? What's your tax policy here? Because we just, obviously for every New Yorker, that's an issue.
Yeah, so how I'm going to pay for it is pretty clear. The plan itself talks about taxing in a different way, and it's called a microtax. And this is something I'm always clear about when I'll need cooperation from Albany, and this is something that I'll need cooperation from Albany. But if we put 0.75% on all goods and services produced in the city of New York or delivered in the city of New York, 0.75%, that will not change any commercial decision-making at all. And we time limit that so that it's just 4 years. We could raise more than $60 billion in money for all of the things that we need and give the business community this kind of confidence that this is a very small tax that will be time limited just to pay for what we need now. That's what you do when you're dealing with a crisis. But for severely rent-burdened tenants, they need help right now. We have a $2.7 billion budget surplus, assuming that holds. If we took $1 billion of that money and gave direct subsidies to the people in this city that are severely rent-burdened, we could get them to rents that are 25% of their actual incomes. That's the kind of excitement that our campaign offers because we have real solutions, not campaign slogans.
All right, Jim, we look forward to seeing your campaign over the coming months here. Jim Waldron, he's a mayoral candidate for the city of New York, joining us here in our Bloomberg Interactive Broker Studio. Appreciate your time. Jim, thank you very much. Let's get back to the Wall Street story at hand. President Trump likely to fire Powell soon, the White House official says. President Donald Trump is likely to fire Federal Reserve Chair Jerome Powell soon, a White House official said, and discussed the possibility move in a meeting with congressional Republicans on Tuesday night. While the lawmakers voiced support for the move, which will likely roil financial markets and lead to a consequential legal showdown. Trump has not made a final decision and could change his mind, according to the official who requested anonymity to discuss a private conversation. To get more on this from markets perspective, we welcome Ira Jersey. He's Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Ira, how do you think the bond market would react to such a move?
Well, firstly, let me say that this is not on has not been on my bingo card. So the fact that we're seriously talking about Chair Powell being removed for cause one way or the other is certainly going to roil the Treasury market a bit. And I think that the initial move is going to be a twist steepening of the yield curve, meaning higher yields in the long end because of fears of inflation and continued fiscal largesse. And on the other side, the expectation that short-term interest rates will wind up going down because whoever replaces Jay Powell will wind up being more dovish and more of President Trump's cult of personality in that way. But we have to remember, it's not obvious that the actual Fed funds is going to be lowered very significantly because of the switch in the chair, because you still have more than half the members of the Federal Reserve thinking that they're only going to cut once or twice this year, or maybe not even at all. So the question is, how much power will that chair have? Because the chair is not a dictator in the Fed. It is a committee. There's 12 members who vote. So unless you get someone who is able to convince a majority of the other members of the Fed to cut rates aggressively, you're probably going to see more modest rate cuts rather than, a 200 basis point rate cut in a very short order.
Yeah, and that leads to my question. I mean, could this all change if the Fed decides to drop rates?
Yeah, well, I think a 25 basis point cut, probably wouldn't necessarily placate the president. I mean, obviously, he thinks that interest rates should be much, much lower. You look at the economy, I'm not convinced that that's true, right? Like, I think that there are political reasons why the president wants it lowered. But from an economic standpoint, interest rates actually look pretty appropriate to me. I have, my model has the neutral Fed funds rate at around 4%, maybe 3.75 to 4%. So, 25 or 50 basis points of rate cuts would get us right there. So we're very close to neutral, as far as I'm concerned. And cutting all the way down to, say, 3% or 2% would risk the potential for faster growth and therefore higher inflation overall, which is, one of the things that the market's pricing for. And that's why once the recent headlines hit the Bloomberg terminal on the president's possible action, you've seen the market move, and that's just going to get bigger. So you saw 30-year yields sell off a few basis points. You saw 2-year yields rally a few basis points to go lower. So you wind up with this twist steepening of the yield curve, and that's not necessarily going to be great for the economy, quite frankly. So even if you have lower interest rates in the short end, long end interest rates are telling you they don't like this, and the market doesn't like this very much.
Yep, and that's kind of what we're seeing there. So we have the 30-year, which we were looking at this morning, touching 5%. We're up at 5.06% of 4 basis points, and that's just in the last few minutes. So just what Ira was talking about, higher rates on the long end. Short end on the 2-year, it's come in 6 basis points. We're now at 3.88% on the 2-year. Ira, at the FOMC, the folks who vote on these rate things, is that public how each person voted, or is that private?
Yeah, so we do know how everyone votes. Typically, there's a consensus that's built, and then you have 1, 2, occasionally, very occasionally, 3 people do what we call dissent, but basically vote no. It doesn't happen that frequently, but it does happen on occasion. So there's the possibility that you can wind up with more dissents among members of the FOMC, basically people voting against a policy, certain policy actions. Now, something that you haven't seen, at least not in my lifetime, and from what I can remember going back to reading these minutes back to the 1970s, I don't recall a Fed chair ever dissenting. I'm not saying it's never happened, but typically the chair will vote with the majority, right? But you have had periods of time time when you've had, 2 or 3 members who've said, hey, we shouldn't be taking this policy action. And the way that we typically view that is like, okay, if 2 or 3 people say no, then it's probably a lot more members. So it's more like not quite half, but close to half. But they don't like to show that there's that much, not animosity, but discord within the committee. But there are people who basically say, okay, look, if we're going to vote, I'm going to vote no. You vote yes because it's going to pass anyway. So why show that we have a lot of discontent with this particular policy action within the committee?
So, Ira, there is some word that Kevin Hassett could be the early frontrunner to take over Fed chair, but some say his closeness, proximity to the president, that could raise some questions about Fed independence. So what kind of impact would that have?
Yeah, well, that's one reason why I would be very worried about the long end of the yield curve, because we know that independent central banks tend to produce longer-term better outcomes than those that have a very strong political bent. And that's, I think, in part because politicians, generally speaking, want lower interest rates, always want lower interest rates. In fact, Chairman Greenspan was very famous in saying, and he obviously spanned over multiple presidents, said he's never been asked by any politician to raise interest rates. It was always about cutting interest rates. So I do think that you do risk having steeper yield curves, generally speaking, and probably somewhat higher yields, particularly 5, 10, and 30-year bond yields are likely to be somewhat higher. And that will increase the borrowing costs for a large portion of the economy, because if you think about that 5-year sector, for example, that's where a lot of people get auto loans and other shorter-term financing, and obviously the 10-year tends to be the most important for things like mortgages. So you can wind up with the housing market maybe being affected if 10-year yields were to go up toward 5% again, and you wind up with 8% mortgage rates, right? That will certainly affect, that'll permeate throughout the entire economy. So having an independent central bank, I think, is very important. And, clearly President Trump wants to have more influence on the central bank. At least that's what, such policy action like removing the Fed chair would certainly show that, hey, I want the Federal Reserve to, use my policies, not necessarily an independent policy from what the White House is looking for.
Ira, in talking to your institutional investor clients, is there some replacement that maybe the market would like, or some replacement maybe they don't like? Have we gotten to that point yet?
Well, it does depend on who it is. I think someone like a Chris Waller, who's currently a governor. Chris Waller is he's currently a Fed governor. He would be kind of he's a bit on the dovish tilt within the Fed, so he would be an interesting person. But he also has deep institutional knowledge, right? He's been on the Fed, the Federal Open Market Committee for quite a while. So I think that he would be someone who, he would be relatively benign for the markets. Someone like a Kevin Warsh, who was a Fed governor, over a decade ago. Again, institutional knowledge. He might be a little bit more dovish as well, but also someone who I think has some respect among the investment community, and has a deep track record in working at the Fed. And I think anyone who in that ilk who has been a member of the Federal Open Market Committee or is a well-respected monetary economist, I think would give the market at least a little bit of comfort. But you're still going to see, if Jay Powell is removed, you still will see a pretty big steepening of the yield curve, I think, and higher yields in the long end.
And that's exactly what we're seeing today. Great. Ira Jersey, always good to talk to you, especially during these crazy times as it relates to the Federal Reserve and kind of how it's being reflected in the market. And we're seeing some movement in the Treasury market for sure. Ira Jersey, Chief U.S. Interest Rate Strategist. All right, let's go get a Bloomberg Business Flash, an update, Charlie.
Thank you very much indeed. Let's recap, reset. If you're just joining us, major news out of Washington, stocks falling, short-dated bonds climbing, all on a news report that President Trump will likely fire Fed Chair Jay Powell soon. Our coverage will continue here on Bloomberg Radio. Keep it locked into Bloomberg for the latest development. Right now, we have got got the 10-year yielding 4.47%, the 2-year 3.87%, and the 30-year, as we heard from Ira Jersey, 5.06%. Again, stocks lower, just about the lows of the morning now, with the S&P down 27, drop there of 0.4%. The Dow down 159, drop there of 0.4%. NASDAQ down 117, drop there of 0.6%. All of this breaking shortly before 11 o'clock Wall Street time. Stocks fell, short-dated bonds climbing on a news report that President Trump will likely fire Fed Chair Jay Powell soon. Our coverage will continue here on Bloomberg Radio. We got spot gold up $41 the ounce, surging 1.2%, 33.64. West Texas Intermediate crude down 1.3%, 65.63 a barrel. And Bitcoin right now is trading higher. Bitcoin up 2.2%, very close to $119,000. So again, our top story, a White House official says President Trump is likely to fire Fed Chair Jay Powell soon and has discussed the possible move in a meeting with congressional Republicans. Keep it locked into Bloomberg Radio for the latest on this developing story. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Lisa Mateo, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Let's follow up to this story that Charlie was just reporting upon. We go to Chris Condon, Bloomberg Federal Reserve team leader. Chris, has this happened before? Has a president ever removed a Fed chief?
No, absolutely not. Closest thing to this was in the 1970s. Jimmy Carter didn't like his Fed chief, and so he gave him the job as Treasury Secretary, which is not exactly firing somebody. So no, we have not come anywhere really close to anything like this.
Chris, now this was announced during a meeting with congressional Republicans, and the lawmakers actually voiced support for this move. I mean, did that surprise you at all?
Well, it depends, which Republicans are we talking about? If you have a small group of Republicans, you could probably find a small group of Republicans that would be adamantly opposed to this. You could also easily find a small group of Republicans that are gung-ho for this. So it depends on who these folks are exactly. But, it is still meaningful that you had some gathering of GOP lawmakers and there wasn't anybody pushing back, at least that we know of. So, yeah, it is quite meaningful.
Hey, Chris, I think, this isn't easy to do. That's maybe one of the reasons why it's never been done before. I'm looking at Bloomberg News reporting, talking about this is not an easy thing to do, as Section 10 of the Federal Reserve Act requires, quote, cause for removal. Talk to us about Section 10 and how that can be used.
Right. Okay. So importantly, this language has been tested in the courts for decades and decades, going back to the 1930s, really. And the courts have examined what lawmakers meant by these words when they put it in the Federal Reserve Act and in other laws establishing other federal agencies. It's a pretty high hurdle. Now, it should be said that hurdle is potentially going to be lowered by the Supreme Court for other federal agencies. Trump has moved to fire some FCC commissioners, and the Supreme Court is hearing that case. And there's a lot of speculation that they will allow Trump to do that. But the court, very importantly, has already, in a preliminary ruling, signaled that they are likely to treat the Fed differently, saying it has unique historical qualities as a public-private institution. Legal scholars have interpreted that as a sign that the Supreme Court will protect and keep this for-cause hurdle in place for Fed governors. So if Trump wants to remove Powell from the Fed altogether, he will have to show cause. Now, historically, that's meant inefficiency, neglect of duty, or malfeasance, according to the legal experts. And that's not just, missing a few dollars here and there. This is real neglect of duty, real incompetence, fraud. It's considered a high legal hurdle. So he would still have quite a fight in front of him if he wants to remove Powell from the Fed.
Yeah, so that leads to my question. Is this more about interest rates, or is this more, President Trump also talked about renovations over at the central banks? I mean, what's the leading factor behind this decision?
Right. Okay. So Interestingly, I point out a couple things here. Powell's term as chair ends in May of 2026, and he has, in some recent, he's been questioned, will he leave, as most chairs do, because he doesn't have to leave, he can stay on as a governor. And he has declined to answer that question. It is since he's done that administration officials have begun to apparently look for other reasons that could satisfy this four-cause hurdle, and they brought up the rehabilitation of two big buildings that the Fed controls, its headquarters, downtown Washington, which are undergoing a very expensive renovation, and they're trying to grab onto this as a cause. Now, many people have viewed this as trying to find some excuse to fire Powell when, in fact, the real beef they have is interest rates. That's what Trump has focused on constantly since being reelected. You hear him almost every day asking for the Fed or demanding the Fed lower rates. So yeah, a lot of people are saying that's really the center of the conflict. And he's using this other issue as the stick to beat Powell over.
Chris, timing, this is all new to everyone. If President Trump were to remove Fed Chair Powell, would Mr. Powell then, I guess, sue as a private citizen, or who would file suit against it?
He would, as the party that is harmed, he would have to sue personally.
Okay.
It would be a big deal. It would be expensive, although he's a fairly wealthy fellow. He could, and he has given indication that he would fight. I think we can expect that. One other thing to note, I think that's very important to add, though, even if Powell were successfully removed, the Federal Open Market Committee sets interest rates, not the chair. So it would not mean that, you know, a new person in charge would suddenly be able to change the direction of interest rate policy at the Fed.
No, that's actually good to know. I didn't know that. So there were a couple names tossed around. You had Kevin Hassett, Kevin Warsh, Christopher Waller. Ira Jersey kind of talked about this earlier. How would you describe the difference between them?
Well, the big difference is between all of the other candidates and Christopher Waller. Waller is a sitting Fed governor. He is a Trump appointee, but he's pretty widely viewed as somebody who will follow his instincts as a very experienced economist. He is at the dovish end of the spectrum at the moment on the FOMC. He has suggested that he'd be ready to cut possibly this month.
Right.
There's some speculation about to what extent he's, auditioning for the job. The others, though, are much more clearly considered loyalists to Trump, especially Kevin Hassett.
Yep.
Kevin Warsh, perhaps less so, but he's been pursuing that job for a very long time.
Right.
And while historically a hawk, he has been talking very dovishly of late.
Chris, thank you so much for joining us. We appreciate your input there. Chris Condon, Bloomberg's Federal Reserve team leader there. Again, the news reporting that Trump is considering firing Fed Chairman Jay Powell. We'll have more coming up. This is Bloomberg.
listening to Bloomberg Intelligence with Paul Sweeney on Bloomberg Radio.
All right, Lisa Mateo, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. Right now, let's go to Washington, D.C. President Trump is meeting with the Prime Minister of Bahrain, taking some questions. We'll listen in.
These are historic, long-time rivalries between different groups in the southwest of Syria, Bedouins, the Druze community, and it led to an unfortunate situation and a misunderstanding, it looks like, between the Israeli side and the Syrian side. So we've been engaged with them all morning long and all night long with both sides, and we think we're on our way towards a real de-escalation and then hopefully get back on track in helping Syria build a country and arriving at a situation there in the Middle East is far more stable. So in the next few hours, we hope to see some real progress to end what you've been seeing over the last couple hours.
Mr. President Jerome Powell, do you have plans, or if you're back considering firing Jerome Powell, and what's your justification if you're thinking about this to do this?
Too late. He's always been too late. Hence his nickname, Too Late. He should have cut interest rates a long time ago. Europe has cut them 10 times in the short period of time, and we cut them none. The only time he cut them was just before the election to try and help Kamala or Biden, whoever the hell it was, because nobody really knew. Obviously, that didn't work, but he tried to cut them for the Democrats, Kamala. And how did that work out? You'll tell me. It didn't work out too well, did it? But I think he does a terrible job. He's costing us a lot of money. And we fight through it. It's almost, the country's become so successful that it doesn't have a big impact. But it does hurt people wanting to get a mortgage. People want to buy a house. He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned. He's doing a little renovation for $2.5 billion of the Fed, building a renovation, and they have a close to $900 million cost overrun. And it's a shame, but the biggest cost overrun is the cost overrun for interest rates, because we should be paying 3 points lower, and we would save $1 trillion a year in interest if that were the case. And all it is the stroke of a pen. And that goes for his board, too, because his board is not doing the job, because they should try and rein this guy in. So he's doing a lousy job, but no, I'm not talking about that. Fortunately, we get to make a change in the next, 8 months or so. And we'll pick somebody that's good, and we'll pick somebody. I just want a fair job. We want to see lower interest rates. Our country deserves it. We're making a lot of money. We're doing great as a country. We have no inflation, record stock market, record business, record everything. Everything's a record now. We had the worst inflation in history under Biden, and now we have almost no inflation. We've done a great job, and we should have the interest rates cut.
So you're saying today that Scott Bessent, you're so happy with him at Treasury that he's not your top option to replace Jerome Powell whenever that may be, whenever you decide what you want to do with him.
Scott's doing a very good job. I'm very happy with Scott.
Is Kevin Hassett on the top of your list?
Kevin's somebody we'd consider. Kevin is fantastic, too. We have a lot of good people for that job. It's not a tough job, to be honest. Assuming you're smart, it's not a tough job. If you're a dummy, then I guess it's a tough job. But it might be one of the easiest jobs I've ever seen. And now on top of it, he's building a close to $3 billion little nest egg for himself. He's not doing the right job. We should be saving $1 trillion a year in interest. When he talks about cost, we should be saving. Think of it, $1 trillion a year. Add that with the tariffs and everything else. But he just doesn't want. He's a knucklehead. But we'll see how that. We'll see how he's listening to this. That's a strange conversation. But we like to say it like it is. But we have a lot of people that want that job very badly. And I'm only interested in low-interest people, frankly, because you don't need. I know. So they had the 71 different economists and people experts that they picked about a month ago. I was the only one, along with one person from maybe the Wharton School of Finance. The two of us got it right. 69 people, including Powell, got it wrong. And he wants to hire thousands of new people to help him decide where we're going in the future. It only takes one good mind. It doesn't take 5,000 good minds. So they're expanding the Fed. It's the dumbest thing I've heard of. But you know, it's very autonomous.
Just to follow up on that, sir, are you completely ruling out the idea of firing Jerome Powell?
I don't rule out anything, but I think it's highly unlikely unless he has to leave for fraud. I mean, it's possible there's fraud involved with the $2.7 billion renovation. This is a renovation. How do you spend $2.7 billion? And he didn't have proper clearance, et cetera, et cetera. So you know that's going on. So, you know, there could be something to that, but I think he's not doing a good job. He's got a very easy job to do. You know what he has to do? Lower interest rates.
Have you drafted a letter to send to PayPal if you decide that you are going to fire him? Have you drafted a letter?
I haven't drafted a letter.
So you didn't show a letter to Republican lawmakers last night?
No, I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. But I'm more conservative than they are.
Mr. President,
we talked about it. In fact, we had 11 of the 12 people here yesterday, you know, for a very big bill having to do with crypto, et cetera, and other things. And all of the votes are going with us, every single vote. But during the conversation, when we were talking about it, I asked, what would you do about that? They all said would fire him.
Mr. President, thank you for taking the question, sir. You were in Pennsylvania yesterday. You unveiled $92 billion worth of investments. One of those jumped out, though, $15 billion in Homer City to build the largest natural gas power plant ever. I was at the rally where you told Homer City residents that you would not forget them when the biggest coal plant in Pennsylvania closed down. You delivered for them yesterday. What message do you have to those residents?
Well, I'm happy. Homer City, I was there, and I said, I'm going to produce something, I don't know what, because they had shut down this massive coal plant, one of the biggest in the country. And it was just purchased by the gentleman that you met yesterday, very substantial man. I don't know if he's maybe not as substantial as you, I'm not sure. But he's pretty substantial. You know who I'm talking about. And they're going to spend billions of dollars on rebuilding it, and it's going to be the largest plant of its kind in the world, I believe, actually in the world, and it's going to be great. So we really fulfilled that promise to Homer City, but it's to Pennsylvania, basically. I won Pennsylvania, and very conclusively won Pennsylvania, so I owe them a big debt of gratitude, but thank you for bringing that up. We raised 92, it's actually going over 100, so it'll be over $100 billion to be invested in Pennsylvania. It was Pennsylvania Energy Project. So we had, everybody was there. Larry Fink was there. I mean, everybody was there and done a great job. The senator did a great job. And we were very proud. That was a great meeting yesterday. Thank you very much.
Mr. President, actually for each of you, so for the Crown Prince, are you planning on taking any of the Patriot missiles that you're going to receive from the United States and divert those to help Ukraine?
We have no current plans as we have an operational requirement inside Bahrain to keep them there for the present time.
He's got plenty of them, too.
And Mr. President, on the fentanyl bill.
They're wonderful. They're wonderful pieces of kit.
They work very well.
American technology is the best.
Yep.
And on the fentanyl bill that you're signing.
Maybe the most important part of this. He has his choice of everything. And we make the best military equipment by far in the world. There's nothing close, right?
Bar none.
Yeah, thank you.
And on the fentanyl bill that you're signing today, do you hope that that's going to restart law enforcement cooperation with China on getting the fentanyl?
Yeah, I think China's been helping out. I mean, it's been a terrible situation for many years with fentanyl, but since I came here, we're talking to them, and they're making big steps. They're also, as you know, being penalized. You know that, right? They're being penalized with tariffs because of the fentanyl, but they want to do something. We'll see what happens.
Mr. President, I know. Thank you, Mr. President. An American from Tampa was beaten to death. He was killed by Israeli settlers in the West Bank. His family has been calling on you to help prosecute his killers. Are you going to do that? An American from Tampa
Yeah, your first sentence is really, go ahead.
An American citizen from
Yeah.
Tampa, Florida, has been killed in the West Bank. His family has been asking you to prosecute him. Are you gonna help finding his?
Yeah, well, so first of all, have you seen yesterday, Ambassador Huckabee has asked the Israelis to conduct an investigation. We want to get all the information about who was involved. We protect all American citizens anywhere in the world, especially if they're unjustly murdered or killed. So we're gathering more information, but I hope you saw yesterday Ambassador Huckabee in Israel asked the Israeli authorities to produce an investigation and concrete information about who was responsible for his murder.
They're reporting that tomorrow. We have a meeting on it. They're going to be reporting that to me. Yeah.
Do you think that the Gulf area now is more secure, and do you believe that a negotiation with Iran is necessary at this stage?
Well, I definitely believe that the volatility of the situation has been reduced. And we didn't know where it was going to go on the Sunday. We were very glad when we found out on the Monday. Let me put it that way. And should the Iranians want to negotiate, I believe the ball's in their court. That is the true reality of where we stand today. They are the ones that stand to benefit from a negotiation.
And they do. They want to negotiate. They want to negotiate badly. We're in no rush because, you know, we said we could have made a deal. They should have made a deal. And then we bombed the hell out of their various places. We're in no rush, but if they want to negotiate, we're here. Yeah.
Mr. President, I know you want to move past all this intrigue over the Epstein files, but I do want to ask you to clarify something you said this morning. You said this was all a hoax. Has your Attorney General told you this was a hoax? What evidence have you seen
It's
of
not
that?
the Attorney General, no. I know it's a hoax. It's started by Democrats. It's been run by the Democrats for 4 years. You had Christopher Wray and these characters and Comey before him. And it's a bad group. It started, actually, look at the Steele dossier that turned out to be a total hoax. The 51 agents, the intelligence, so-called intelligence agents, it was a hoax. It's all been a big hoax. It's perpetrated by the Democrats. And some stupid Republicans and foolish Republicans fall into the net. And so they try and do the Democrats' work. The Democrats are good for nothing other than these hoaxes. They're bad for policy. They're bad for picking candidates that can get elected. Like in New York, we have a communist running. He may get elected too, actually, but he'll destroy the city. No, it's I call it the Epstein hoax. It takes a lot of time and effort. Instead of talking about the great achievements, we've had a great gentleman. Yesterday, as you know, went on CNBC and he made the statement that Trump may go down as the greatest president of all in the United States. And instead of talking about the things we've achieved, we've had tremendous achievement. They're wasting their time with a guy who obviously had some very serious problems, who died 3-4 years ago. I'd rather talk about the success we have with the economy, the best we've ever had, and all of the things we've done, including the Middle East. I mean, you see it. Instead, they want to talk about the Epstein hoax. And the sad part is it's people that are really doing the Democrats' work. They're stupid people. Yeah, go ahead.
There's lots of reports coming into this meeting that you planned on firing Fed Chair Jay Powell. Markets reacted.
Is that right? Those are reports, but they're not true.
So what would be useful to know, are you committed to picking someone from the outside? Are you going to interview individuals that are
so
on the
many
board
people
right
that
now?
want that job. I have people that I've known a long time. They're calling me, begging for the job. You know what you need there? A smart person with common sense, but you need a very smart person for that job. I think it's one of the easiest jobs in government. You show up once a month and you make a statement about where the economy's going, and we're going to raise or lower interest rates. It's probably the easiest job I've ever seen. That's why I'm trying to figure, why does he want to expand and add more people? He's going to add more economists to tell him what to do. But the economists, I was right. All the economists were wrong. They admitted it. They admitted it this morning. Quiet. Go ahead.
Mr. President, on Jerome Powell, you mentioned fraud in an earlier answer. Are you saying you want to investigate the Fed chair for fraud related to this renovation?
Well, I think he's already under investigation. He spent far more money than he was supposed to on rebuilding. I didn't see him as being the kind of guy that would want to have parks, rooftop parks and everything else on top of buildings, but who wants to spend that money for the Fed? The Fed is supposed to sit there and say where interest rates are going and a couple of other very easy things to do. And he spent $2.5 billion. I think he's got some problems.
Mr. President. Thank you, sir. You also recorded a monthly surplus in the month of June, $27 billion. A ton of money. With these new tariff rates coming into effect on August 1st, we're going to be bringing in even more tariff revenue specifically. How much revenue do you think we can consistently bring in from these tariffs, and how big of a game changer is this, not only for the economy, but also fiscal responsibility?
Well, we're going to be bringing in, already we've brought in over $100 billion. We'll be bringing in hundreds of billions of dollars. And the tariffs really haven't kicked in that much other than automobiles and steel. August 1st is a big day. August 1st is when very substantial money comes into our country. We've made deals with a lot of great places, but we had one yesterday, that was announced. We have another one coming up, maybe with India. I don't know. We're in negotiation. When I send out a letter, that's a deal. In other words, that's a deal. They don't want to ever say that, oh, how many deals have you made? The best deal we can make is to send out a letter. And the letter says that you'll pay 30%, 35%, 25%, 20%, in one case 50%, Brazil, and because what they're doing to their former president is disgraceful. I know the former president, he fought like hell for the people of Brazil, that I can tell you. And I believe he's an honest man. I think what they're doing to him is terrible. So, yeah, we have some pretty good deals to announce, but every time we send out a letter, that's the deal. The big one really is going to be on the 150 countries that we're really not negotiating with, and they're smaller. We don't do much business with them. Because you have a lot of countries. You have over 200 countries. And a lot of people don't know this, but we'll have well over 150 countries that we're just going to send a notice of payment out, and the notice of payment is going to say what the tariff, and it's all going to be the same for everyone, for that group. They don't, they're not big countries, and they don't do that much business. It's not like the ones that we've agreed with, like China, like Japan, where we're negotiating with them, but I think probably we'll live by the letter with Japan. We're very close to a deal with India where they open it up. Indonesia yesterday was, it wasn't an open country, now it is. And they have tremendous copper, quality copper, and probably the most copper. And we made a deal with Indonesia. We pay no tariff, zero, and we have total access to trade. That's a phenomenal deal for our companies. And we've agreed with them, as you know, on 19%. They pay 19%. And it's a good deal for them, it's a good deal for us, so in that case. But we have a number of them coming up. But overall, we're doing well, and we're taking in a lot of money, a lot of money. We have the number one, we have the most oil of any country in the world, even more than them, which is hard to believe. But we have a little larger piece of land, right?
We do, sir.
But we're number one in the world in oil, and we're drilling, and today it hit $64 a barrel, which is great. And that'll help stop wars, actually. If you want to know the truth, it's going to help stop wars. And we hope to get it down a little bit more. But we have oil down to $2, $2.25, $2.50 in numerous states. We hit one at $1.98 a gallon. And that's a great thing. That's one of the reasons that inflation's in check. When you can do that, you stop the inflation. What Biden did is he ended our policies, went to his policies. He doesn't have a policy. Some lunatic around the desk had a policy. Whoever operated the auto pen had a policy, which is, by the way, I think the biggest scandal. That's the scandal they should be talking about, not Jeffrey Epstein. The scandal you should be talking about is the auto pen, because I think it's the biggest scandal, one of them in American history. So the economy is doing really well, and people are seeing it. Yeah.
Mr. President, will you ask Attorney General Pam Bondi to release more documents to finally put this controversy to bed?
Whatever's credible, she can release. If a document is credible, if a document's there that is credible, she can release. I think it's good. But it's just really, It's just a subject. He's dead, he's gone, and all it is the Republicans, certain Republicans got duped by the Democrats, and they're following a Democrat playbook. And no different than Russia, 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 and all the other hoaxes. They're started by the Democrats, and some Republicans, in this case I was surprised, but they got duped.
But have you talked about it? Have you talked about it with her the last week?
President, first of all, a number of your high-ranking officials, whether it's been your FBI director or Pam Bondi, they have made some inconsistent statements in the past. You've had.
Well, I don't know. I can't speak about him, but I can say that Pam Bondi, I really think that she's done very good. She says, I gave you all the credible information. And if she finds any more credible information, she'll give that too. What more can she do than that? I mean, honestly, what more can she do? And we do have bigger problems. You know, we have problems with millions of illegal people that came in here, and they're killers and murderers. We have 11,888 murderers that were allowed into our country by Biden, sleepy Joe Biden, stupid Joe Biden. He allowed them into our country. And you know what? We got to do something about it. She's got a lot of things she's working on. And, you know, it's very sad that somebody can be waylaid, that just get waylaid. But I think she's doing a great job, President.
Truth Central this morning, you mentioned past supporters when you were talking about the Epstein issue. Does that mean that you're effectively disowning any supporters who are now calling?
I lost a lot of faith in certain people, yeah. I lost, because they got duped by the Democrats. The Democrats are good for nothing. They've done a terrible job. They almost destroyed our country. If I didn't get elected, all these numbers you're hearing about, they found $25 billion and another 25 is coming in, and hundreds of billions of dollars is pouring into our country. And we just got the biggest tax cut in history. We just got the biggest regulation cuts in history. There'll be no tax on tips. There'll be no tax on Social Security. There'll be no tax on overtime. There'll be no tax on so many other things. You're allowed to deduct your interest from a car payment. That's never happened before. You borrow interest. You borrow money to buy a car if the car is made in America. And by the way, factories are being built all over America, car factories, AI factories, but you get a deduction on your interest. Nobody ever thought of that before. It never happened before. And, you know, these are the things that they should be talking about. The big, beautiful bill is one of the greatest pieces of legislation ever in this country. And the Democrats have nothing to combat it. So they say, oh, it's death. Oh, that's good. And then they give it to the fake news, which is you and a few others. And the fake news talks about the bill is death. The bill is actually life. The bill is life, and it saves our country. This bill is incredible. Look at the results already. So we have $16 trillion being invested in our country. And this great gentleman and his family just came in with another billions of dollars. And if he didn't like the country, if he didn't like where we were going, he's very smart. He'd come, maybe he wouldn't even come. I think maybe he wouldn't even come. He'd save your time. But, because, you know, it's one of those things. But if he didn't like where this country was, he wouldn't be investing billions of dollars in this country. But think of it, $16 trillion, more than has ever been even contemplated before. And we haven't even started yet. So that's what I want to talk about. I want to talk about the success. And the Democrats have nothing to show for what they do. They almost destroyed. They allowed 25 million people to come into our country, gang members, jailbirds, from all over the world, not South America, from all over the world. They allowed them to come into our country from mental institutions, insane asylums, just walk right through. They couldn't come into your country. They couldn't come into any country in the world except our country. And they came in from the worst places, gang members, drug dealers. They all came in. Turn it off, please. They all came in, and I'm doing something about it. We have it under check right now. We got rid of a lot of the murderers already. Some of them we put in our prisons because they're so bad we don't want to take a chance in putting them in a foreign prison, have them come back. But we've done a great job. Our country's in great shape. We literally have the hottest country anywhere in the world right now. And it's true what the king said, what a lot of people said. we were a dead country. 1 year ago, we were a dead country. We were laughed at all over the world. We had Afghanistan with that horrible embarrassment, most embarrassing moment in the history of our country. Look what happened with Russia and Ukraine. That should have never happened. Look what happened with Israel. That would have never happened. Hamas had no money. Iran had no money. There was no money to do an attack like that. All these things that happened that wouldn't have happened if you had good leadership. And that's what you should be talking about. Thank you very much, everybody. Thank you.
And that's a wrap in the Oval Office. President Trump sitting next to the Crown Prince and Prime Minister of Bahrain for a conversation that, assumedly behind closed doors, will focus more on the Middle East and the economic relationship between those two countries. But of course, that question and answer session with reporters largely focused on another story we're following here on Bloomberg Radio. Welcome to our audience on radio and on YouTube, if that's how you're joining us, as President Trump says he is not planning to fire the chair of the Federal Reserve. We're going to dig into this here on Balance of Power. Now, I'm Kaylee Lyons alongside Mike Shepard in Washington today. And of course, Mike, coming into this hour, we had multiple reports that the president actually was considering firing the Fed chairman, but Trump says those reports are not true. He denies drafting a letter to fire Powell and says he simply talked about the concept of firing him with Republican lawmakers at the White House last night.
That's right, Kaylee. It came up last night during this closed-door meeting with Republican lawmakers, and it seemed to be a step closer, at least in private, toward what Trump has been musing about, at least in publicly, stopping short of saying that he would fire the Fed chair, but at least expressing a great desire that he leave the job. What he did signal today, though, is perhaps some patience and willing to let Powell stay in the job until he has a chance to pick a replacement. We know that search is actively underway.
Yeah, he said, fortunately, we get to make a change in the next 8 months or so. And regarding that search, he says his priority is that he's only interested in low-interest people, as in people who want lower interest rates. He did have some kind words for Kevin Hassett, who's currently the chair of the National Economic Council. He said Hassett is someone he would consider for the Fed chair.
And he was asked whether he would look to an outsider, perhaps in response to the speculation that Hassett or even Treasury Secretary Scott Bessent could be a strong contender for the position as well. So clearly he has one goal in mind, and he referred to the European Central Bank's decisions to cut rates. He said 10 times over the past year in comparison with the U.S. He has repeatedly called Powell too late on making interest rate decisions and moves, and sees the Fed's slowness in cutting rates as a big liability.
Yeah, and obviously all of his comments around the Fed chair and the reports we got earlier today have taken markets on a bit of a wild ride. We had stocks down at session lows on the reporting that a firing may be imminent. We're off of those lows now, so we want to get a check on financial markets and turn to Charlie Pellet with a check on Wall Street up in New York. Hey, Charlie.
Hi, thank you very much, Kaylee Lyons. Indeed, all of this coming to a head right around 11 a.m. Wall Street time. Let's recap, reset, bring you up to date on what those fast-moving developments are out of Washington. Stocks fell, short-dated bonds climbed after a White House official told Bloomberg News President Trump is likely to fire Fed Chair Jay Powell soon. The dollar halted a 4-day advance. The Bloomberg Dollar Spot Index down now by 0.2%. But in comments moments ago that you heard live here on Bloomberg Radio, the president said he is not planning on doing anything to remove Fed Chair Jay Powell. Firing Powell, though, would test the legal bounds of Trump's authority. Chris Condon is Fed team leader at Bloomberg News.
The court, very importantly, has already, in a preliminary ruling, signaled that they are likely to treat the Fed differently, saying it has unique historical qualities as a public-private institution. Legal scholars have interpreted that as a sign that the Supreme Court will protect and keep this for-cause hurdle in place for Fed governors.
Chris Condon, Fed team leader at Bloomberg News. Now, the president did say he's only interested in hiring, quote, low-interest people for Fed chair, saying it's an easy job, also saying you just need someone with common sense. Equity markets lower right now, but let's stress, well off session lows. Right now, we have got the S&P at 62.33, got down as low as 62.01. You recall, hit a record yesterday of 6,300. Right now, the S&P down 10, drop there of 0.2%. The Dow down 19, decline of under 0.1%. Nasdaq Composite Index down 46, drop there of 0.2%. 10-year 4.47%, the 2-year 3.90%, and the 30-year 5.03%. Gold up 0.7%, Bitcoin up 2.3%, and a retreat for crude down 0.7%. Again, the Bloomberg Dollar Spot Index down by 0.3%. Our coverage continues right here on Balance of Power. Back we go to Washington. Once again, your host. Here she is, Kaylee Lines.
All right, Charlie Pellet, thank you so much. I am indeed Kaylee Lines alongside Mike Shepard in Washington today, where we have all been following each and every headline regarding the Fed chair, Jerome Powell, and whether or not his firing may be imminent, as President Trump has signaled increasing impatience with the Fed's lack of desire, it seems, to cut interest rates at this time. And despite reports earlier today, as we just told you and you just heard from Charlie, the president said in the Oval Office that he is not intending to fire the chair of the Federal Reserve, knowing, of course, that his time as Fed chair is going to expire in May of next year. That timeline the president drew attention to moments ago.
We get to make a change in the next, 8 months or so, and we'll pick somebody that's good, and we'll pick somebody. I just want a fair job. We want to see lower interest rates. Our country deserves it. We're making a lot of money. We're doing great as a country. We have no inflation, record stock market, record business, record everything. Everything's a record now. We had the worst inflation in history under Biden, and now we have almost no inflation. We've done a great job, and we should have the interest rates cut.
So for more on this, we turn to two experts here at Bloomberg. Laura Davison is with us, our Deputy Bureau Chief here in Washington, alongside Stuart Paul, who is a U.S. economist for Bloomberg Economics, joining us from New York. Laura, just to begin with you, as obviously the president did say that earlier reports that he was considering firing the chair were inaccurate. We know that he has still been very vocally critical of the chair, continually pushing to lower interest rates. There is a growing push toward an investigation around potential fraud or lying to Congress around the renovations of the Fed building. Despite what he said, there were a lot of signs pointing in the direction that the chairman's time might be running short.
Yes, there were, in addition to the weeks of comments that have been very critical of Powell, in a meeting last night with lawmakers on Capitol Hill, as Trump was trying to get some of these holdouts to support a crypto piece of legislation, he talked about firing Powell. He showed them a letter, according to people that we've spoken with, that sort of have laid out firing Powell. This is clearly, Trump is sort of using this as a trial balloon and as a piece of leverage as he tries to achieve a couple different political fronts. One is he had a group of people in his office who very much wanted to see Powell go he was essentially able to get them to come out and say, yes, they would support this crypto bill in exchange for, we don't know exactly everything that happened behind closed doors, but this was one of the things he talked about. In addition, he's also been looking to change the conversation around Jeffrey Epstein. This has become a real flashpoint in the Republican Party. Everyone's talking about Powell today and not Epstein at all. So this is Powell is going to be gone from, his seat as Fed chair, by May of 2026, by, essentially less than a year from now. But this is a game that we may see Trump really try to play out and use it as a leverage point for weeks and months to come.
Stuart, speaking of weeks and months, that is about the amount of time when we think about Trump and the Federal Reserve that we have seen him putting this kind of pressure on Jerome Powell and the central bank over interest rates, even if he has not actually followed through on the threat that he appeared to be floating in private to Republican lawmakers. Even with all those statements publicly, what does that mean for Fed independence going forward?
The closest thing that we have in economics to a free lunch is central bank independence. Independent central banks tend to deliver lower, more stable inflation at a minimal cost to growth. So when the president is stepping on the Fed's toes in jeopardizing that sort of Fed independence, it's exactly taking away the one thing that monetary policymakers and the broader economy should like to retain, one thing to keep in mind is as these threats to the central bank's independence become more pronounced, as they were with some of the headlines that we saw earlier this afternoon before the president denied floating the idea of firing Powell, as Fed independence suffers or is at least under threat, it's actually entirely likely or increasingly likely that other members of the FOMC could end up standing up to attempt to assert their independence and not deliver the exact cuts that the president would want by threatening to fire Powell.
Stuart, that's a great segue to comments that we heard yesterday from Treasury Secretary Scott Bessent during an interview with our own Anne-Marie Hordern. He talked about perhaps Jay Powell leaving the central bank's board after his term as Fed chair ends, and that would be leaving the board early. Let's take a listen.
Traditionally, the Fed chair also steps down as a governor, and there's been a lot of talk of a shadow Fed chair causing confusion in advance of his or her nomination. And I can tell you, I think it'd be very confusing for the market for a former Fed chair to stay on also.
Stuart, do you see the current Fed chair heeding this commentary from the Treasury Secretary, or does he take the cue of history and actually exit the board as well when his term as Fed chair ends?
Yeah, so there are a couple different things that Secretary Bessent is putting forward. The first idea that the Fed chairman would leave his role as a member of the Board of Governors when his term as a leader of the board, as chairman of the board, ends up expiring. That is very normal. There are only two instances that I could think of in history where a former chairman stayed on as a member of the Board of Governors. I think that Powell would follow tradition and leave the Board of Governors. But this idea that a shadow chairman would introduce additional confusion, Mike, Kaylee, Laura, I would just remind you guys that the idea of a shadow chairman was first floated during the campaign cycle by Scott Bessent, when the idea came up that somebody could be appointed before the end of Powell's term as chairman. So while he's right, it would add additional confusion. We were saying the exact same thing when he was threatening to impose a shadow chairman on the current Fed chairman, Jay Powell.
Yep, I remember speaking about that with Scott Bessent before the actual election took place. And Scott Bessent did come up in the Oval Office, Laura. He was asked by a reporter, would you look at Scott Bessent to be the next Fed chairman? Trump signaled that he's satisfied with the job Scott Bessent is currently doing in his role as Treasury Secretary, but did note that Kevin Hassett is, quote, fantastic and someone he would consider. Is this going to be a battle between the Kevins, the other one being Kevin Warsh?
This certainly could be. Trump famously, he had my Kevin that was Kevin McCarthy. He could have a new Kevin in a very key role here in the next little bit here. But there's a couple names that have been floating. One, Kevin Hassett, currently, at the White House, the NEC director. Kevin Warsh, who has long wanted this job. Trump, in fact, interviewed him during his first term. He ended up giving it to Powell because he thought Kevin Warsh looked too young. Of course, now this is 8 years later, so maybe he'll have grown into that role. Chris Waller, also someone on the Fed board who has been a name that's been thrown about. Scott Bessent himself is also, sort of in that mix, though it's really been twice in the past 2 days. Trump has been asked about Bessent. He was even yesterday specifically asked, is Bessent your number one pick? And he said no, essentially. He's like, he's fantastic, mentioned that he wants him to stay in his role at the Treasury Department.
Laura, are we getting any sense that some Republicans may be trying to put the brakes on the talk of Trump trying to fire Jay Powell, doing something that, really we have not seen in decades?
Yes, this is something that also rattled markets, but rattled lawmakers on the Capitol Hill who have sort of pushed to move slower. You saw some other moderates saying, "Hey, maybe you should just wait to see what happens at the July meeting, perhaps the August meeting." This is really an issue because they see both. This would be unprecedented. It could really throw markets into a tailspin. At the same time, when we have all these tariff deadlines coming up in the next couple weeks as well, where you could see prices drastically increase, and you see members of Congress already worried about some of the political risk related to the tax bill they just passed, don't want to have an even more uncertain economic outlook.
Well, as Laura puts our attention on prices, Stuart, it is worth noting we, of course, had softer than expected CPI, at least on the headline figures yesterday for the 5th month in a row. Underneath told a bit of a different story. We also had cooler than expected PPI today. So what is actually happening in terms of the feed through of higher tariffs leading to higher costs? How should we be analyzing this data?
The effect of tariffs were basically clouded by some of the headline numbers that came in, as you mentioned, lower than expected. Both core CPI and all the PPI figures came in lower than expected. But when you look below the surface, the prices of things like appliances, home furnishings, clothing, a lot of imported goods, a lot of those imported core goods within the CPI were materially higher in the month of June. When we then sharpen our pencils and map the CPI and PPI components into their core PCE price index equivalents, which is what the Fed cares about, that core PCE price index, we're getting to about 0.3 to 0.35% month-on-month core PCE inflation, which is still going to be too hot for comfort for the Fed to cut rates. The Fed is going to have this estimate when they get to their July meeting. It's most certainly going to be keeping the Fed on hold in July, and frankly, it could be enough to keep the Fed on hold even through September. We are seeing some of the line items associated with higher tariffs showing accelerating prices. It's going to keep them uneasy.
And Laura, going to you, the top line number, Stuart was talking about sharpening the pencil and going deeper, but for the administration and the president in particular, they will look at that surface number and say this is enough for Jay Powell to start cutting rates. Is that what we're seeing?
That's exactly what we're seeing. And really, no matter what the data is, they almost have their statement ready to go and then send that statement out regardless of what the headlines actually indicate. But this is, their narrative has been that Powell needs to go. He's too late. Interest rates continue to be too high. Trump has said he wants them to come down, as much as 3 points. That would be, a big drastic shift. And that's what he's going to be as he talks with all these candidates. He essentially trying to figure out how much sway will he have on exactly determine where those interest rates could be with a new Fed chair.
All right, Laura Davison, our Deputy Bureau Chief here in Washington, alongside Stuart Paul, U.S. economist for Bloomberg Economics. Thank you both for joining us as we deal with this changing narrative here from potentially soon firing the chair of the Federal Reserve to not considering firing the chair of the Federal Reserve. At least that's what the president is saying at this time.
Yeah, we'll be waiting to see what tomorrow brings on this front from him and whether there are further meetings with lawmakers on this.
Yeah, tomorrow or today. He has a bill signing later this afternoon. There could still be plenty more commentary coming from the president, and we'll get into all of that and much more with our political panel up next here on Balance of Power on Bloomberg Radio and on YouTube. I'm Kaylee Lyons alongside Mike Shepard.